The real focal point right now should be on earnings.
Earnings continue to be the North Star.
Earnings are strong, but valuations are also very high.
Equity investors just forgot about the idea that there might be some short-term pain involved.
There are still risks on the horizon.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday following a volatile 3 days. Tensions continuing to simmer between the US and China as Fed Chair Jay Powell is keeping October rate cut bets alive. Investors are looking to results from Morgan Stanley and Bank of America to wrap up earnings on Wall Street.
So there could be some optimism right now in this market. At the same time, you do have this cloud when it comes to the rhetoric between the two biggest economies. The latest salvo being between President Trump saying that maybe we're going to cut off Chinese cooking oil. At the same time, the hot rhetoric, government shutdown, still in a data desert. And what is Jay Powell saying, the Fed chair? Basically, time is standing still for us. We are still in September, and the bias is to the labor market.
Let's deal with China and the US first. Let's break that down. So last week it was rare earths. This week it's shipping, soybeans and cooking oil. I'm just counting and running through the list. Is this positioning for negotiation, or is this just the direction of travel now for the rest of the president's term?
I think it's a little bit of both. Both of these economies have shown that they're willing to go for these industries that both economies are relying on, that need and the world needs when they want to get something out of a deal, an upcoming meeting with China. So we have this upcoming meeting potentially. So what are you going to do before that? You're going to increase the rhetoric. I thought the Financial Times reporting was really interesting because it talked about the fact that China brought this up in the summer and said it wasn't going to do it, and they would be prepared to, but wouldn't do it. And all of a sudden, they started doing it again. China knows that that is the lever to pull when they want to get the U.S. attention when it comes to rare earths. And China knows when they want to get, especially a Republican president's attention, it's to go to soybeans.
So companies are starting to engage and make multi-year investment decisions. This from Stellantis, $13 billion. 4-year plan to invest in the United States. At the same time, check out the news over at Apple. Tim Cook of Apple over in China this week, vowing to boost investment in China. I can't wait for the White House to read those headlines to see their reaction to it.
Because what they want to see is that companies invest more just in the United States. And if anything, we've seen some companies even go more to India, which Apple has done in the past. This is what is the problem when you have rhetoric like this and destabilizing trade headlines. Companies don't know where to act. At one point, potentially, could this all escalate to a point where the U.S. is basically banning some companies to operate in China or delisting Chinese companies from the U.S. stock exchange, which is why most people say this is all a hedge. These economies are too reliant on each other, and this is the levers they want to pull to have a negotiating tool into the meeting at the end of the month.
If you are just tuning in, welcome to the program. So the state of play in financial markets, futures bouncing back, equities higher by 0.6%. Later this hour, numbers from Bank of America. Next hour, around 7:30 Eastern time. We should wrap things up with Morgan Stanley. Coming up over the next 60 minutes, we'll catch up with Marvin Lowe of State Street as Powell keeps the door open for rate cuts. George Pollack of Signum Global as US-China trade tensions continue to simmer. And Chris Marinak of Jenny Montgomery Scott as we wrap up earnings for the big banks on Wall Street. We begin this hour with stocks bouncing back as Chair Powell keeps rate cut bets alive. Marvin Lowe of State Street is writing the following. We're on board that one should price another cut at the end of the year, even if we're still in the December pause camp. Marvin joins us now for more. So, Marvin, the more interesting call there is the December call, because October, it looks like Chairman Powell set us up for a rate cut. What is it about December, the data, the backdrop, that makes you think this Fed is going to pause?
Yeah, we still think that inflation is, part of the dual mandate that the Fed's going to focus on. Data that we're looking at, the alt data that we have access to, is showing that it's getting a little bit bubbly again in October after, really being somewhat muted throughout the summer, which was a surprise to everyone. But it's going to complicate the discussions for the Fed for sure, in our view, as they kind of get near the end of the year.
So, Marvin, why won't it complicate the October meeting? Because they probably will have CPI. They may not have the jobs report.
Yeah, I mean, for sure. So, I think most of the committee clearly is on board with at least one more cut. Whether or not there's one more cut versus two more cuts at the end of this year is something that the committee's pretty split on for the most part. So, there's no doubt that there is weakness in the jobs market that did not really make its way into the data over the summer. I mean, we kind of heard that from Chair Powell yesterday. And, within that insurance kind of cut discussion, it's consistent with what we've heard up to now, that the labor market concerns are going to be driving these short-term decisions.
Marvin, though, isn't the path of least resistance to hold in October when you don't have the data and then cut in December when you have more of a full picture of what's going on in the economy?
Yeah, I mean, certainly that makes sense. I think from a risk management perspective, if we kind of listen to what the Fed was saying over the summer versus what they were saying in September with Jackson Hole in between, and the concerns that really started to pop up around the economy, there's nothing that has happened since September that would make those concerns less. If anything, with the shutdown, with potential impacts on consumption at the federal worker level, the potential for furloughs, that all is a strange brew that ultimately one concludes is probably worse than where we were in September, even though the Fed is saying things are, for the most part, not that much changed. If they were apt to cut, which they were, they're going to be more apt to cut it, is the way I interpret it. But certainly what you're saying makes sense. I just think that they would rather get that one out of the way. Jay
Powell said that yesterday, and then he went on to say, and yet people are spending. Yet this is a resilient economy. Yeah. So on some levels, they are cutting into strength, are they not?
Yeah, for sure. And that's kind of the longer term concerns that, those of us that are kind of looking further out the curve and thinking about structural potential changes that really keeps the 10-year somewhat elevated relative to what you would expect during a cutting cycle. And I think that also is making its way into kind of how bond investors are evaluating all of that longer term inflation discussion.
Yeah, Marvin, let's dig into this. I think it's worth exploring. Yeah. Do you believe the weakness we're seeing in payrolls growth is an outlier, one? And two, do you believe that's largely driven by structural factors or cyclical factors?
I think that there is a bit of both. Not trying to dance around the situation, but I do think that supply is a big part of that discussion. And if we kind of put supply into that and think that, replacement value, if you will, how many jobs have to be created without the unemployment rate increasing is closer to or below that 100,000 job level per month, the job market doesn't look as weak as what we've seen in terms of, history, if you will, and certainly within recent time. And immigration is a big part of that. So yeah, there's a structural component to it, which complicates it, which I think also plays into the discussion at the end of the year going into next year.
This is the risk, I think, Marvin, and we have to think about more the kind of upside risk that it might lead to in financial markets as well. That maybe it's the outlier, that the Fed gets lulled into reducing interest rates when the rest of the economy seems to be okay, and financial conditions are already incredibly loose. And what's interesting about the financial market commentary of the last 24 hours, particularly from the big banks on Wall Street, is that the numbers are good, but they've got concerns about valuations. The CFO of Citi, Mark Mason, said it's hard to look at how equity valuations of multiples sit today and not think there are some sectors that are likely frothy and overvalued. Jamie Dimon at JP Morgan had this to say on private credit markets: I shouldn't say this, but when you see one cockroach, there are probably more. Marvin, how are you approaching a situation where the backdrop seems to be pretty decent, financial conditions are very loose, and the Federal Reserve is obsessed over one data point, rightly or wrongly, and it's payrolls growth?
Yep. And Jamie Dimon really does have the best sayings. It really does come down to, and I keep, as a rates person, as kind of a bond person, you always come back to inflation. And there's an inflation component to that, whether it's a function of their ability to get to 2% or the volatility around inflation. Do we enter a phase where everything that you mentioned, Jonathan, creates less certainty that inflation becomes anchored? Whether it's anchored at 2% or 2.5% is part of the discussion, but just being anchored is as important. And if it's not anchored, you need more compensation around that. What we've seen from kind of institutional buying of equities is that it hasn't been as robust as what the indices would show. There's more of a buy and hold because everyone, for a certain degree, is frozen in this world where the numbers are still coming out positively in corporate America, but valuations are so high that, I'm not going to add a lot to it, but I also can't sell right now.
Marvin, so where does this leave the Fed in 2026 if you do have a scenario where inflation is becoming unanchored?
Yeah, so one of the things that I found really interesting, number one, is that we know that the Fed's view on where neutral is, kind of that long-term debt that we talk about, has been creeping up. But even if we look at their projections going into 2028, they don't have it going back down to 3% yet. So 5 years after the start of this cutting cycle, if you will, if we kind of take the Fed the forecast, they don't believe they can get to 3%. So I do think that we wind up finally acknowledging that neutral rate, where the Fed finally stops cutting, is not only higher than 3%, but potentially not that far from where we are now.
Marvin, enjoyed this. It's good to hear from you, as always. Marvin Lowe there of State Street, breaking down his thoughts on the Federal Reserve and what it means for financial markets as well. Later on today, plenty more Fed speak. Governor Waller speaking later on this afternoon. Remember, the blackout period begins this weekend, going into the Federal Reserve meeting 2 weeks today. As we think about inflation and the pursuit of that inflation target over at the Federal Reserve, a lack of credibility maybe. Gold up for a fourth session. Gold, record highs, up almost 60% year to date.
Gold is so high and it's becoming this safe haven that even Jamie Dimon, who doesn't really like it, is like, I can maybe make somewhat of a case that you should maybe have it in your portfolio now, even though he doesn't love the idea of that. It's because where else do you go? Risk on in the equity markets. At the same time, tons of geopolitical fragmentation and concern, and the Fed's going to be cutting interest rates. So you're just going to pile into the precious metal.
And that's what's been happening all year. 4,200 on gold this morning, up by 1.3%. We have an update on stories worldwide. Let's get to your Bloomberg brief and cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. President Trump, as you've been speaking about, threatening to stop trade in cooking oil with China. The potential move comes as retaliation against Beijing for its refusal to buy American soybeans. Trump posted on Truth Social, "We can easily produce cooking oil ourselves. We don't need to purchase it from China." Trump is expected to meet with China's Xi Jinping later this month. ASML shares rising after orders beat expectations, with AI demand staying strong. The semiconductor equipment maker is citing positive momentum around AI investments and a growing pool of customers. ASML optimistic on plans to ride the AI boom in the coming years, but noting business in China will be lower. LVMH shares are surging after the company saw an unexpected return to sales growth in the third quarter. Sales at all divisions exceeded analyst estimates and demand picked up in China, suggesting the persistent sales slump in luxury is finally beginning to ease despite uncertain macro conditions. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie later this hour in about 30 minutes' time. Up next on the programme, Tough Talk.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us.
Up next on the programme, we'll catch up with George Pollack of Signum Global, live from New York City this morning. Good morning. Your day ahead shaping up as follows. More bank earnings later on this morning. In about 30 minutes' time, around half an hour away, we should get numbers from Bank of America. In the next hour, 45 minutes later, should get results from Morgan Stanley. So Brian Moynihan's head pick set to report through the next 60 minutes, 90 minutes plus. Those results should wrap up earnings on Wall Street. Then later on this morning, 9:15 Eastern Time, check this out. Ambassador Greer, Treasury Secretary Scott Bessent, both speaking at 9:15 at a time where tensions are really starting to simmer between the US and China.
Obviously, this is going to be about China, and if their press conference is not, all the questions are going to be about China. Ambassador Jameson Greer yesterday was talking about whether or not that 100% tariff that the president threatened on China goes through. Depends a lot on what China does. AKA depends a lot if China decides to allow rare earths to go out and be exported into the world, including the United States. This is really the issue and the biggest chip China has on the table going into those talks.
It's whipsawed financial markets since Friday, Monday into Tuesday's session. This morning we bounced. We'll see if it holds. Up by 0.6% on the S&P, higher by 0.8 on the Nasdaq. On the Russell this morning, positive and outperforming by more than 1 full percentage point. Under surveillance this morning, tough talks with China.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us. But we have a fair relationship with China, and I think it'll be fine. And if it's not, that's okay too. We have a lot of punches being thrown, and we've been very successful.
So here's the latest this morning. President Donald Trump threatening retaliation against China for purposefully not buying US soybeans. Bloomberg's Jack Fitzpatrick joins us now from Washington, D.C. Jack, welcome back to the programme. It's been too long. Let's talk about what's on the table this morning. Cooking oil. And over the last week, it's been shipping, been a range of things. Soybeans been on the table for a while. Rare earths has been something in the background we've all been thinking about for the last several years. Jack, is this all positioning for leverage in negotiations at month end, or is it something more?
I think what we can say for sure is that President Trump does not want to go into a conversation with Xi Jinping around the end of the month and go towards that threat of an additional 100% tariff on November 1st from a position of weakness. His tactics on these always are leaning forward, trying to be the aggressor and not end up kind of trailing back on his heels. It'll be up to Scott Bessent and Jamieson Greer to follow up in a press conference to describe maybe in a more nuanced way exactly what their approach is. But just looking at history and President Trump's usual approach, I think it's safe to say he knows what's on the calendar in a couple of weeks, and he wants to demonstrate that he can walk away or he can inflict additional economic pain on China if need be. That's how he goes into these discussions, trying to set himself up to be on offense rather than defense.
Jack, let's just stay with the Treasury Secretary. Annmarie was talking about this just yesterday. The Treasury Secretary is changing his approach somewhat. He's trying to get the rest of the world on side as well going into this meeting at month end, calling on India and Europe to join them, because ultimately some of the decisions that China is making, particularly around rare earths, won't just punish the US, it might punish everybody else too. Jack, is that going to be the strategy into month end?
There's a lot to keep track of going towards the end of the month, and you're right that it's up to Scott Bessent and everybody else in the Trump administration to figure out how to align the broader tariff and trade strategy with a focus on China. That is a difficult task. I will say it's difficult to read into President Trump's comments and his approach on China and apply a distinct logic to everything else that goes on in the big picture, because we know how significantly President Trump is focused on kind of man-to-man discussions. He wants that meeting with Xi Jinping. I wouldn't necessarily read into his comments and his approach going towards the end of the month as if he has a distinct vision for how he wants Scott Bessent to carry out his approach on India and the rest of the world. The way Trump usually focuses on this is how can I go into the discussion I want to have with the other principal in the position I want to be. It creates a lot of chores and a lot of complex work for the people around him, but that's his approach, and I'm not sure necessarily that the president himself has thought of how he wants to approach India and other major countries vis-a-vis his comments on China.
It's a very different approach. Jack, appreciate it. Jack Fitzpatrick there of Bloomberg down in Washington, D.C. Annmarie, you know well, you go to these meetings often. Typically, the diplomats get together months ahead of time. They hash out the whole thing 99% of the way. The leaders turn up and they sign off on the thing. The president has a very different approach, and it generates the results others can't generate, particularly the Middle East, a great example of all of that. What kind of results is it going to generate when he sits down with the Chinese leader later this month?
I think the base case is because the current truce on the tariffs expires November 10th. They'll be meeting before November 10th. I think the base case that these two leaders meet, they say more work needs to be done, but there's an extension of the truce. Maybe they come out with China buying some more soybeans and a little bit more of a lifting of restriction on rare earths. I think that could be a base case scenario. But the president is setting it up also to escalate on a much more different approach. And your point about Europe, Germany is finally saying they are concerned about these export issues. They are talking on the national level and the EU level, but will they do anything about it is the question.
Joining us now is George Pollack of Signum Global. George, welcome to the show. The focus quite rightly on international issues in the past week, particularly a fantastic success. Could be a crowning moment for the president in the Middle East. Next up is China. Back home, we've still got a government that's shut down. George, are we just ignoring what's happening at home?
I don't think we're ignoring it. I think it's very much omnipresent, especially if you're flying in an airport, if you're interacting with the government whatsoever. What I think is the administration has understandably been focused on the Middle East this past week, and now that seems to be in the past, they're going to turn and now see a more explicit focus on resolving the shutdown.
George, you think it gets resolved by November 1st. What are the pressure points between now and November 1st that get this shored up?
The biggest pressure point by far is the notion that healthcare enrollment opens November 1. And while that doesn't mean you have to enroll that day, we're going to see millions of Americans exposed to the reality, either that they don't have healthcare insurance coming next year, or that their premiums are going to go from $300 to $1,000. And for the president who's been so focused on prices, that's just not a solution he can accept.
So what's the off-ramp? How do they actually open the government?
I think the reality is the off-ramp has to be some kind of climb down from both the Democrats and Republicans. Democrats have to understand they're not going to get a comprehensive subsidy deal while the government is shut down. Republicans don't want to give that, and they don't want to incentivize further hostage taking in the future. Republicans have to understand that they need to give Democrats something once the government reopens, and that's a substantial and real negotiation on the future of these healthcare subsidies.
At the same time, the president, he was doing this yesterday, was talking about potentially more of these furloughs becoming permanent layoffs. And he says that these would impact people that are working on Democratic policy objectives. What is he talking about?
Between you and me, it's something that I don't really understand as to what he's talking about specifically, because these programs impact all 50 states, and when he impacts one House district, he's impacting an entire state. When he impacts a whole state, he's impacting Republicans. The past projects they've threatened and the past firings they've done have impacted horribly moderate House Republicans who are crucial to keeping the majority. So while they're saying they're targeting them, in reality, there's unintended consequences that include Republicans taking the fall for their state losing money and their state losing jobs.
We saw that yesterday. We had Congressman Mike Lawler on the program, and of course they froze billions of dollars of infrastructure spending in New York, and that's going to be impacting the congressional district he sits in and represents in Westchester. So do you view this all as threats to try to get moderate Democrats in the Senate to vote for the clean resolution?
That's exactly what this is. This is basically, I know you have a ton of federal workers in your district and your states. If you don't vote for the CR, we can make it that much more painful. And you've kind of seen that take an effect. Yesterday it was reported that the likes of Angela Alsobrooks in Maryland, the likes of Ruben Gallego in Arizona, these states with heavily federal presence of federal workers, are talking about making a way out of this shutdown. They see this as a significant vulnerability, and they want to address it before the damage becomes even more permanent or more severe.
Hey, George, it's got to get your thoughts, as always. George Pollack there of Signum Global. George, thanks for joining us. George, not alone. Many people like George thought this would end quickly. Secretary Bessent managed to manoeuvre things to make sure the military gets paid in the middle of this month. It's going to be the next date in 2 weeks' time that might be the crunch point for many.
That's going to be a problem. They can get enough funding together and move some funding around budget so they get the payroll done by October 15th. But what happens on October 31st? Great point there by George about the Maryland senator, though. Maryland has 2 senators. Virginia has 2 senators. They're all Democrats, obviously. These are the areas where the federal workers are really going to be calling their constituents and say, okay, we want to get paid. You need to reopen the government.
Are you starting to see the cracks?
We are. I think you're starting to see the cracks for some of these moderate Democrats. So I understand why George thinks potentially it could be November 1st. But if the Trump administration is able to maneuver some money for critical and essential individuals, maybe it can go longer.
The government shutdown continues here on Wall Street. The volatility continues as well. Friday, Monday, Tuesday. This morning so far holding steady, up by 0.6% on the S&P 500. Coming up this hour, we'll be catching up with Jill Ford of Wells Fargo on the IPO resurgence. What a year so far. We'll get into the numbers in just a moment. Plus, Yahira has your morning movers. Papa John's shares jumping on reports that Apollo has submitted a bid to take the pizza chain private. That stock in the pre-market is higher by almost 12%. Papa John's up by 11.65%. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Live from New York City, welcome to the program. 3 hours away from the opening bout. A price action shaping up as follows on the S&P 500. What a 3 days. Friday, Monday, Tuesday. Friday, the biggest one-day drop since April. Monday, the biggest one-day rally since May. Tuesday, an almost 2 percentage point swing on the S&P 500, just about finishing the day down. On the S&P 500, positive by 0.6% on the S&P. On the Nasdaq, up by 0.8. On the Russell, up by 1 full percentage point. And we'll see if these gains hold. Across the board in the equity market, turn to the bond market. 2-year, 10-year, 30-year bond yield shaping up as follows. 2's at 347, close to multi-year lows. On a 10-year, I don't think we've had a close with a 3 handle since April, so look out for that. The 10-year just north of 4% at the moment, down by 2 basis points on the day. And let's finish on gold. The rally for the year. Only a second ago, we were up 50% year to date, and now we're up almost 60. 4-day winning streak, up another 1.4% so far this morning.
And a lot of strategists are saying this is just going to continue into next year, potentially 5K on gold next year. I was actually shocked by Jamie Dimon saying he can maybe actually kind of make a case now for putting gold in a portfolio. Someone who would say never do that. It's not worth it. But look what's going on in the world. You have really hot rhetoric where a lot of unknowns are what's going to happen at the end of the month with this meeting between Xi Jinping and President Trump. The Fed doesn't have data, but they're still cutting interest rates at the end of the month. So if it's risk off, you're a little bit nervous. Why not put in the precious metal?
The data they will have will be CPI on October 24th, and inflation may well print 3%, and they'll still be cutting. Gold's at 4,200 at the moment. We'll come back to that story later. Bank earnings on deck, remember. Bank of America should drop in about 15 minutes' time. Then we're waiting for Morgan Stanley 45 minutes after that. So that's your setup for the next hour or so. Let's get you some single names, some morning movers this morning with Yahara Arnold. Hey, Yahara.
Hi, John. We start with NVIDIA. Shares are up nearly 2.5% as Microsoft lines up another buyer for its chips. Nscale, an AI data center developer, will build a site for Microsoft in Texas where it will deploy more than 100,000 of NVIDIA's most sophisticated chips. And just to highlight the demand here, this is the 4th deal we've seen between Microsoft and Nscale in the past 2 months. Meanwhile, moving on to Bloom Energy, though, that stock also popping nearly 5.5% in the pre-market as UBS hiked its price target to $115, though. As you can see, we are trading above that. It comes as analysts have rushed to raise their price target after the stock saw a 27% pop on Monday after Brookfield unveiled an investment of $5 billion in the company. And from tech to pizza, we end on Papa John's surging 12% in the pre-market on a Reuters report that within the last week, Apollo submitted a $64 a share bid to take the pizza chain private. No deal is guaranteed, but it does mark a trend with these private equity firms buying up these restaurant chains from Subway to Jersey Mike's for steady cash flow despite their thinner profits. John?
Yahara, thank you. Appreciate it. More from Yahara in about 60 minutes' time. On our radar this morning, more bank earnings on deck. Bank of America, Morgan Stanley set to report. Investors watching for strong results and profits in trading and deal making. Elsewhere, ASML shares rising on stronger than expected orders for the third quarter, with bookings hitting $6.3 billion. The company seeing sales for next year holding steady, fueled by the massive boom in AI infrastructure spending. And finally, President Donald Trump threatening to cut off imports of cooking oil from China, retaliating against Beijing for its refusal to buy American soybeans. Trump calling China's refusal to buy those soybeans, quote, an economically hostile act.
So it looks like the cooking oil would be a direct response to soybeans. I don't think anyone thinks they're going to put soybeans and rare earths and chips on the same sort of table. So cooking oil, soybeans, maybe they can work that out. It's going to come down to these rare earths. Will China be willing to lift some of the restrictions they put on their rare earths? We are talking about the fact that China owns the market. They own the rare earths, they process them, they sell them. It is more than 75 to some of these, it's 95% of the market. And it's not just hurting the United States, it's hurting everyone that is a buyer right now.
The president's approach typically is escalate to de-escalate. And we've seen that play out fantastically well in places like the Middle East, particularly the developments of the last few months and particularly this week. With China this time around, it feels different. And Peter Chia of Economy talked about this. This time, it's not the US doing the escalation. In the last week or so, it's China doing the escalating. And you just wonder how that complicates the president's strategy into month end.
Well, it sounds like Xi Jinping maybe picked up a copy of Art of the Deal and is trying to match Trump in terms of how he negotiates. I think at the end of the day, both these leaders know how intertwined their economy is. But remember Trump's first administration? It took 18 months just for agricultural purchases. Do we really think they're going to be able to nail down a host of issues that go way beyond soybeans in just a matter of months? Potentially that's going to be challenging. They could meet, but these talks could extend well past their meeting.
For those of you tracking this story, if you're looking for an update, we should get one around 9:15 Eastern Time. Scheduled to speak, the Treasury Secretary, Scott Bessent, alongside Ambassador Greer, so look out for that in a few hours' time. Let's turn back to markets. EY reporting the global IPO market rebounded in the third quarter, rising 19% year over year in deal volume, with the US leading the way. Jill Ford, co-head of Equity Capital Markets at Wells Fargo, writing the IPO market is now past volumes we saw for the whole of 2024. September is the best volume month since the final manic innings of 2021. Jill joins us now for more. Jill, good morning.
Good morning.
It's good to see you. Let's talk about the numbers. Just how stunning has this been for you and the team?
Well, I was here, and thanks for having me back. I was here back in July, and I was, as you could tell, wildly optimistic about what 2025 was going to have in store for ECM, particularly around IPOs. The IPO market was beginning to thaw. There was a nice diversity of IPOs coming out, different sectors, different market caps, different growth profiles. And it was finally at a point where buyers and sellers were coming together and finding common ground. And the deals obviously traded great. The IPO cohort for 2025 is right now up 35%, double what you could get in terms of the S&P or the NASDAQ. All of that has come to a bit of a halt in October. We saw 16 deals come from Labor Day onwards. As you mentioned, September, the largest volume month we've seen in quite some time. And now we're sort of stepping back. There's a couple of wrenches in the plan. And people are wondering whether or not the last couple of months, which are always challenging in terms of windows to get out, might prove to be, not as fertile as I hoped and push some people into 2026.
We'll talk about some of the wrenches in a moment. You mentioned diversification. How diverse were some of the listings? Because typically all we hear about now is AI, and more AI. Is it more than just that?
AI certainly sucks all the air out of the room. And it's not just AI itself. It's, the broader tech landscape around AI. It's energy to fuel AI. It's real estate. There's so much that touches that theme. And I think people are not only looking at the picks and the shovels and, the actual moat around the technology, but all of the ecosystem that goes around AI. So that in and of itself is a very investable theme. But beyond that, you've seen insurance services, you've seen fintech, you've seen obviously around the crypto infrastructure as well. You've seen things that are quite boring come out that people want to buy. And there's all different types of investors who are looking through different lenses as it relates to their portfolios. I've been really encouraged by not just the diversity of companies, but the diversity of buyers who have come to the table as well.
The volume is just so stunning from where we were this time last year. Is it all down to the regulatory environment in Washington?
It's a couple of things. One is we've had an incredible backdrop, very low volatility. Broadly speaking, the VIX has been quite low. Markets, everyone sees the markets marching up, but up until this past Friday, we had not seen a move of more than 2% since April. So every time things got a little frothy, they came back down. Every time there was a dip, there were people in to buy it. And that is an incredible backdrop for IPOs who have to be out for 7 or 8 days. Fast forward to October 1st, we're now in a place where, there's the trade rhetoric that you mentioned, which is causing people to take pause going into year end. And then, of course, the government shutdown puts a lot of people on ice. There are 2 camps of companies that are in different stages of coming public. One who have comments from the SEC, who are considering their options. They're limited, but they have options. There are others who need the SEC to be open to move forward. They're likely, if we don't see some movement soon, going to be forced to push into next year.
Well, the shutdown on Trump 1 lasted 35 days. Is there potential that maybe people just put everything on ice until next year and we have another kind of frozen IPO market from now until year end?
I think it will, if the SEC does not reopen, it will be muted, certainly. There are ways for certain companies to get out. There's a 20-day rule where they can declare a price range and a size, which is tricky, right? 20 days is a long time in this marketplace to be out there exposed, and you whittle down your options in terms of where you can ultimately get done. But there are ways to get out. It's for the companies that were a little bit further behind those, in terms of getting comments back from the SEC, that will see their options push forward into next year.
Can we finish on longer term trends, just briefly? Private for longer is a phrase we've all heard a lot of. Private for longer. And you heard Yahira about 5-10 minutes ago talk about the potential for Papa John's to become a private company, given the reports of Apollo's potential involvement. How are you thinking about that concept? And is that a concept that you're challenging? Private for longer, companies going private, public companies reducing the number of them.
It's all about options. I think many private companies have access to a much deeper investor base than ever before. And so if it works within their growth strategy and growth plans to have that private capital to put off, and what I call it is treading water until you go public, those are incredible options. And there's lots of different ways to skin the cat with respect to privates. It's not just your plain vanilla crossover round that exists today. I think ultimately for many of these companies, they're big companies. They will have voracious appetites for capital, and the public markets are the ideal place to do that. So I do think eventually, again, the pipeline is massive. We've seen a muted IPO volume for years. We're now starting to see people get shaved off into next year. There will be a long time where people need room to access the window that exists, and staying private for longer is certainly an option for many of them.
Treading water. Tells you there's an inevitability about them ultimately becoming public with that phrase.
Right. I love that idea of they're treading water. But you have to think, if you are a corporate executive and you saw what the regulatory environment was under the Biden administration, you do all this work. Trump comes into power. You basically want to get in right in the beginning. But if you're nervous about trade headlines, shutdown, maybe you wait a little bit. But this looks likely is going to persist.
Jill, it's good to see you. Thanks for dropping by.
Thank you very much.
Appreciate the update. Jill Ford there of Wells Fargo. Let's get you an update on news worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. It is day 15 of the U.S. government shutdown, and President Trump is renewing his threat to cut federal programs. He says he'll have a list of priorities headed for the chopping block this Friday. The Trump administration has already terminated more than 4,000 federal workers and suspended funding for clean energy and transportation programs in Democratic-run states. There could be an upset in the race to become Japan's new prime minister. Surprise candidate Yuichiro Tamaki could get the backing of 3 opposition parties who met earlier today. It would prevent the governing LDP from taking the premiership again after its ruling coalition collapsed. Tim Cook is betting big on China, pledging to boost investment despite the ongoing U.S. tariff threats from President Donald Trump. The Apple CEO met with China's industry minister today, who urged closer cooperation with local suppliers. Apple still leans heavily on the country for iPhone production, even as it diversifies some manufacturing to India and to Vietnam. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on our program, resilience on Wall Street.
Markets have been very resilient in the third quarter. We expect over the next 12 months, you'll see a real pickup within the banks, more mergers and acquisitions, especially if rates continue to trend down.
That conversation up next with Chris Marinak of Janney Montgomery Scott, plus Scarlett Fu breaking down the results in just a moment. From New York City, you're watching Bloomberg TV. Stocks are up this morning by 0.6% on the S&P, on the Nasdaq 100 bouncing back by 0.8%. Bank earnings coming through this morning. Bank of America just dropping. Morgan Stanley coming up later. Let's get to these results. The stock is up by more than 2%. Scarlett Fu, I see a lot of beats this morning from this name.
Yeah, and we're getting a beat here on the most important line here for Bank of America, and that is net interest income. That is, of course, the difference between what the bank makes the difference between what it lends out and what it spends on deposit. And that is a key measure here for this bank because of its massive consumer presence. $15.23 billion versus the consensus estimate of $15.03 billion. And this kind of sets up Bank of America for its investor day next month, where it'll kind of guide out what it sees in terms of net interest income going forward. Helping to underpin that net interest income number is loans. Loans coming in higher than anticipated, $1.17 trillion, while total deposits did miss by just a hair. $2 trillion versus the expected $2.02 trillion. And continuing with the theme of markets trading revenue and investment banking revenue beating, we certainly got that with Bank of America here too, with trading revenue at $5.35 billion, better than the anticipated $5.01 trillion, as well as investment banking doing better than expected, $2.01 billion, whereas analysts were looking for somewhere in the neighborhood of 1.6. Just to keep in mind here, some of the provisioning for downturns in the economy and bad loans. We're looking at provision for credit losses of $1.3 billion, which is less than what analysts had anticipated. They were looking for $1.61 trillion. So again, this is a good news story here for Bank of America, especially with that net interest income number. And the stock is being rewarded up 3.4% in pre-market trading after yesterday gained 2.5% following day one of bank earnings. John?
Scarlett, this was great. Thank you. Scarlett Fu there of Bloomberg. Scarlett's going to be back with us when we get numbers from Morgan Stanley in about 42 minutes' time. So this is a beat on wealth, investment banking, beat on trading revenue, beat on net interest income. Upside surprise across the board here. Net interest income for the third quarter, $15.23 billion. The estimate, $15.03 billion. Put it together with yesterday, JP Morgan also beating estimates. Citi, revenue beat in every single division, and it was a record third quarter for the likes of Goldman Sachs. That stock this morning now, off the back of these numbers, up by 4%. Chris Marinac of Janney Montgomery Scott writing the following. Themes for the quarter are resilience in bank earnings as the investment banking and trading areas create plenty of additional revenue for any credit issues. Chris joins us now for more. Chris, welcome to the show, sir. What a morning.
Thanks,
what a
John.
24 hours for bank earnings so far. Chris, you said credit issues. How many credit issues do you see?
Well, for B of A, it's very limited this morning. They had a very small change in past dues. They had non-accrual loans behave very well, and the charge-offs were excellent. So, you have to like what they did in the quarter. I think if you see problems, they did not emerge as of 9:30. So it's very encouraging on these credit details.
What do you make of what's going on in credit, though, overall? Jonathan earlier in the morning was talking about this Jamie Dimon quote about if you see one cockroach, there's probably more on the way. Mark Rowan was talking about how it does not surprise me that we're seeing late cycle accidents. A desire to win competitive market sometimes lead to shortcuts. Do you think this is going to become a problem in the years to come?
Well, I think you're going to see incremental issues, and I think so. Will you see more problems? Yes. Is it something that the banks can defend with earnings and existing reserves and capital? That's also yes. So I think that they can handle this quite well. But it's like the weather changing. It's not going to be sunny and 75 degrees outside any longer on credit. We're going to have a few issues. And as we transition into fourth quarter, first half of next year, I do think you'll see more. It's just that the charge-offs have not been that great in the industry, and the banks continue to earn a lot of revenue to cover any shortfalls on credit as they emerge.
Well, it feels like it's sunny and 75 degrees this morning for Bank of America. Even when you look at advisory revenue, this is coming from the banking side of the house. What's going on in the IPO market? We just spoke to a guest about. Revenue came in at $583 million, well above what analysts were expecting. Chris, is that where these businesses are really driving this growth in revenue?
At this time, yes. I think that the spread income at the bank could come back. We still haven't seen enough loans go on the books at the regular way bank business, but I think on the capital markets and trading side, it is very strong with a very good pipeline ahead.
This stock looks good this morning. Bank of America higher by more than 3%, Chris. Just to go through the numbers again, revenues, profits growing across every segment, revising guidance for net interest income to the top end of the range as well. So a good story to tell for the likes of Bank of America. And Chris, maybe a good story to tell at Investor Day. Investor days aren't something that we typically see from Bank of America and Brian Moynihan. And a few weeks ago, we saw a bit of a reshuffle for the leadership beneath him, just a reorganization, if we can call it that, Chris. How pivotal is this moment for this bank, Chris? What are you looking for?
Well, the company wants to have a comeback, and I think as they transition, they want to try to be another alternative to JP Morgan in the marketplace. So the Investor Day is very important. I think the reshuffling of management is always a good idea to continue to put their best foot forward. And I think the results today speak of volumes of what the company's trying to do.
Morgan Stanley's coming up next, Chris. Based on what we've heard so far, I imagine it's a sign of things to come. Is that fair?
Yes, sir. I think you will see a repeat at 7:30.
Goldman Sachs already behind us. Good. JP Morgan, decent. Bank of America, great. Morgan Stanley, the same again, according to Chris Marinac. Chris, I want to talk about the regional players with you as well. Big change in the past few weeks. Fifth Third taking out Co-America. And we expect to see more. It's really, really strange to see M&A benefit everyone, Chris, including the banks, because the banks are getting together themselves. How much of that kind of action will you see in the next 12 to 18 months?
Well, typically one deal begets a second, begets a third. So I think the question is going to be, will we see something before year end? And we may not, but I think we will see more as 26 develops. There is a gap between regional bank pricing and other bank stocks. And so that gap in terms of valuation is what led to Fifth Third buying Comerica, doing it on very good terms for book value and earnings. I think you can repeat that with other transactions. We have a very clear regulatory highway now to do M&A, and that's going to work at all ends of the spectrum, at the regional level, at the mid-cap level, and beyond. So I'm very encouraged by what we saw with Fifth Third, and I think you will see more of those repeated.
As we talk about Bank of America, looking at Morgan Stanley, could they be buyers when it comes to what's going on in the M&A and the consolidation in the banking sector?
I see them more as advisors on deals in the bank sector. I don't see them as a buyer. They could be buying elsewhere in the financial ecosystem to boost up other parts of their scale. But I think the regional banks will primarily be the consolidators, along with other mid-sized banks who are trying to graduate to the $50 billion level.
And then the big banks will just benefit from being these advisory firms. Chris, is there a sense in the banking industry that they would need to get this done when it comes to the M&A opportunities while the regulatory environment is on their side in Washington?
Well, sure. I think the window still is 3 years long. I mean, we still have plenty of time to do it. So I think the reality is as companies can have their stock prices improve, earnings continue to accumulate, capital builds, you can see more M&A. That's why this is not just a fourth quarter or first quarter of 26 event. It really happens over multiple quarters, in my opinion. And I think the more that these companies have stronger earnings and capital, it just affords them the luxury of considering these strategic deals.
You look at these earnings and you wouldn't think that there's a tremendous amount of clouds on the horizon when it comes to trade policy with the world's two biggest economies, that the U.S. government is shut down. Chris, how do you look at these banks going forward as they deal with a number of risks, especially when it comes to the uncertainty out of Washington?
So the biggest change in my career the last several years has been lower leverage. The banks are simply not putting the same leverage out as other private capital or even insurance companies in real estate. So that low leverage is going to give them a less charge-off number as we go through time. Yes, they will have bumps and bruises associated with lending, but I don't think you're going to see the losses be anywhere near as high as we saw 15, 20 years ago. And that's going to build more confidence with investors that the banks actually know a lot more of what they're doing in this cycle, and they can limit the losses and continue to build returns. I think the compounding of bank capital is very strong, and that's also going to feed off of the M&A cycle.
Hey, Chris, it's good to see you. Thanks for jumping on. Chris Marinac of Janney Montgomery Scott is going to stick with us as we wait for those numbers from Morgan Stanley. So stay close. Morgan Stanley about 35 minutes away. Bank of America just dropped in moments ago. Numbers really decent across the board here. Investment banking fees up 43%. That's been the theme at the moment. It's just beats across the board. If you're worried about credit quality and what's happening with credit and some of those issues, I know it's a massive focal point, particularly given the issues over the last few weeks with First Brands and Tricolor. This came from PNC just moments ago. Decent numbers from them too. Here's the quote from the CEO. Credit performed well and we continue to build on our strong capital levels. So we're not seeing these scary signals come from a variety of the banks that where you sit here and say there's something to be worried about here in a big way. You have these idiosyncratic issues, and I think we're just hoping that we're not going to see more of them. But I do think we got a dose of reality from Jamie Dimon when he turned around yesterday and said, when you see one cockroach, there may well be others. And
he said it wasn't our finest moment. Clearly, this is something that they certainly regret. It doesn't feel like it's systemic, but you do see top financiers, top CEOs talking about the fact that there is a little bit of a warning sign here.
Up next on the programme, we'll catch up with Steve Orth of Federated, Tobias Adrian of the IMF, Tony Rodriguez of Nuveen, and we get more bank earnings. We'll catch up with Chris again in just a moment.
We're looking across at the macro outlook. We're still feeling pretty positive.
The gap between where GDP is and where the jobs market is, I think is the key issue.
With the Fed's focus on jobs, they cut 25 basis points in October.
It's not entirely clear what would catalyze the Fed to change its view.
To a certain extent, we are flying blind right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now with numbers from Morgan Stanley just around the corner, about 30 minutes away. Equity futures higher, session highs up by 0.6% on the S&P. What a volatile 3 days. On Friday, the biggest one-day drop since April. On Monday, the biggest one-day rally since May yesterday. A 2-point range on the S&P 500. Just unreal stuff. This morning, up by 0.6%. A helping hand coming from this name right here. Bank of America in the pre-market higher by 3.8% following some really strong numbers from that bank. Beats across the board.
Beats across the board. Bank of America really firing on all cylinders. The banks are just crushing it. If you put this together, what we heard yesterday from JP Morgan, on track for another record year of revenue. Goldman Sachs notched its best third quarter results on record. Citigroup, the best performing U.S. bank stock right now with this turnaround plan with Jane Fraser, which for a while Citigroup was dealing with a ton of regulatory issues in Washington. The banks are crushing it across the board. Obviously, everyone is talking about, though, what potentially the risk is, and that's the cockroach.
The bar getting higher and higher. Morgan Stanley about 30 minutes away. Later, make sure you don't miss this. I think it's worth watching, particularly given the tension between the US and China and how that's driven markets over the last 3 sessions. Secretary Besson, Ambassador Greer, 9:15 Eastern Time, set to speak together as both sides, the US and China, position for leverage ahead of negotiations at the end of the month.
And that'll potentially tell us how we're going to close today, depending on what those two individuals say regarding this relationship. They are still working towards this meeting between the two leaders. But every single day, there's a fresh salvo from Washington or Beijing, and the rhetoric just keeps getting amped up. Last night, it's cooking oil because of what's going on with China shrugging off American soybeans. Earlier this week, it was ports, sanctions on a U.S. subsidiary of South Korean ports. Last week, it was rare earths. This is just going to continue. The knob is just going to be dialed up even more as we get towards the end of the month.
If you are just joining us, welcome. Equity futures session highs up by 0.6% on the S&P 500. Coming up this hour, Steve Orth of Federated Hermes as Bank of America beats estimates. Chris Marinac of Jenny Montgomery Scott with Morgan Stanley numbers coming up next. And Tony Rodriguez of Nuveen as Powell puts the Fed on track to cut interest rates. We begin this hour with stocks finding a firmer footing as big bank results roll in. Steve Orth of Federated writing the following: it is possible that many companies will fail to beat whisper numbers of bigger than expected beats. This could cause some modest pullbacks for the stock market and for the market generally. Stephen joins us now for more. Steve, good to see you, sir. Good morning.
Good morning.
Thanks for being here. You said earlier this year, tie yourself to the mast, close your eyes, shut out the noise, and just keep moving forward with the ship because it's going to be okay.
Yeah.
Is that still the approach?
Yeah. We actually just set at this time of the year, we always set our 2-year target. We have a 1-year target also, but I'd like our clients to think forward a little bit further. That's kind of our horizon. We've got a 2-year target on the S&P of 8,600. And we don't think it's unrealistic to get there. You have a GDP that's reaccelerating next year. You've got multiple drivers of that we've talked about extensively. You have an AI industrial revolution going on that we think is very, very real. And importantly, and this is a key element of our forecast, is we have margins expanding on the S&P. And, most people at this time of year tell us that we're at peak margins. How many times have we heard that? So I had my guys go back and check this. We have relentlessly expanded margins on the S&P. Okay, 1 or 2 years you might dip a little bit, but the trend has been higher every year. And we think that's a combination of the mix of the S&P shifting towards higher margin, higher cash flow, lower asset businesses that just have higher margins, and productivity enhancements, which are increasing partly due to policy and partly due to AI. So when you add that all together, it's pretty realistic, frankly, to see earnings on the S&P by 28, which is where we'll be looking at in 27, getting close to $400 a share.
Talk to me about the multiple. When you describe the mix shift, what kind of multiple does that mix shift warrant?
So this is another heuristic that we've been talking about on this show for a while now, but that really, I think, fails people. The heuristic is, a fair multiple for stocks is 18 times. And in a 3% inflation environment, that's roughly been the case over a long period of time. But that's when the S&P was largely an industrial and financial index. If you adjust for the mix shift of the S&P over the last 5 years, where it's now largely a tech index, these are businesses with high cash flow, high return on investment. They're clearly, mathematically, worth a higher multiple of earnings. And when you adjust for that dynamic, we think the right multiple on the S&P is about 22 times. So we would say it's fairly to cheaply valued right here. So we're using 18 for the everything else, and we're using 25 to 28 for the Mag 7, if you will. And we get to a fair multiple of 22. So I think those two things are what make us more optimistic. And I think they're actually quite realistic.
I just want to say this up front, that the following statement are not my words. It's John Stolfus of Oppenheimer. He said the boomer mentality was holding people back and keeping them out of the market because of what you just said. Is that what you're confronting on a daily basis with investors?
Yeah, I mean, so many investors, this is one reason why we've been talking about a secular bull market. By a secular bull, I mean a market that does 10x over 20 to 30 years. You get only one a generation. I mean, we've only had two up to now. We're in the third one. I'm counting the move from off the Great Depression lows. We had a 20-year run, then the move off the 73, 74 crisis, which ended in 99. And then in 2013, once we broke through the old highs, we started this new secular bull. And one thing you always need to have is you need some sort of an industrial revolution happening. We've got that. And two, you need to have people have nearly lost their shirt in a historic way as the base, because that creates the wall of worry that's very hard. And you mentioned it, the boomers. A lot of boomers got almost wiped out in 07, 08. It was scary.
They're conditioned by that.
Yeah. And then you have, that's why you have these corrections along the way that just reinforce that fear. I mean, look what happened in late March, early April. Even Wall Street was running for the exits. And a lot of people raised cash. And now we've got this wall of cash. Everyone is very anxious to get back in. They've realized they're wrong, but they don't really want to say it. And that's why the corrections, I think. I mean, we've had a 30% move here without a 5% correction. That's like almost unprecedented over 6 months. So, we're feeling that there probably should be some kind of a pullback. My guess is it'll be lighter than you think because so many people are anxious to get back in. And we put out a piece this week that listed 6 ways you could get a pullback and, thinking through each of them. And, some are obvious, like, the Fed shutdown goes longer than thought, but a lot of them are self-correcting. I mean, if the government shutdown goes much longer, the pain on either side is going to be so high that they're going to have to come back to the table. The ones that I think could be more serious are China. I think, frankly, the comeback this morning on cooking oil was actually an attempt to de-escalate, because cooking oil is not really important to China. So, in a way, they kind of pulled a thing there that's like saying, hey, by the way, we do have other things too, but let's try to de-escalate this talk. But I think Xi's use of his one real ace, which is rare earths, I think that was a mistake on his part. I think even the Europeans are thinking, well, we have to figure out another way. We got to detach ourselves from these guys. And, it's going to take time. So we'll have some sort of interim deal at least, but we're probably on a program to get out of that. We can't have China controlling the rare earth production. So,
If this is your case about the potential choke points to the one big beautiful world in your piece, and trade you think potentially is going to offer the biggest headache, from now until when these two individuals meet, is that going to be an opportunity for a catalyst for these people that are sitting on cash to get back into the market?
Well, we're seeing that, right, Annmarie? I mean, we had a pullback on Friday, again on Tuesday, and money just keeps coming back in. So we'll see. I think if they come away at the end of this month with a kind of divorce, which I think is highly unlikely, but if they do, then we could have a more serious correction.
If you're so nervous about China's hold on rare earths and they're dictating what they're going to basically be able to export to the rest of the world, do you think the U.S. is having the right approach by having equity stakes in companies that are important for national security?
Yeah. Yeah,
You don't think it distorts capitalism?
Well, I'll distort capitalism in this case because we need to have rare earths, right? And what Trump understands is the Chinese were subsidizing rare earth production, and they drove the U.S. and European rare earth producers out of the market, basically. They underpriced the market and drove them out of business. So if, it's such an important element of almost everything in the economy, including our military. I think it's the right call here to say, look, whatever is the Chinese are going to do, we're going to support production of this key element of what it takes to, because otherwise you're in a real vice grip.
If free markets and open trade only works if everyone embraces free markets and open trade. And China over the last few decades did not do that, which is why you've seen the Republicans shift in the last 5-10 years. They're willing to sacrifice elements of capitalism at the altar of national security. Yeah. And I think President Trump has led the way on that.
And Steve is exactly right. The big issue, of course, is what it means for the supply chain to the U.S. Defense Department. Almost every single weapon has these rare earths in them. And that is why it is a challenge when China has 90% of the market.
There's a few contradictions that kind of make me laugh, but one of them is the auto market over in China. People will say that tariffs don't work. They'll be the same people that celebrate the auto market over in China. Yeah. Just try and sell a BMW 20 years ago into China.
Impossible.
They were all pushed to go in there and produce there. And now everyone's celebrating the auto market in China. That's quite a contradiction, isn't it?
Yeah. And what we're thinking and looking at here, Jonathan, is we're thinking that post the settlement of this, let's call it the near-term plan for these economies to detach, which will take 3 to 5 years, which companies have major exposures to China? And, how is that going to play out? I think it's not a surprise that you see Apple today making a big investment in China, because they're one of the companies in the S&P, big ones, that have major China exposure, Tesla being another one as an example. So they're going to have to play both worlds. Apple's China investments, I can assure you, are not to export from China. They're to keep a Chinese market. They need it for their revenue base. So, and that's possibly a viable option, but this is going to be one of the things they're going to have to sort out here is who really depends on China, because that's going to be, I think that market is going to be kind of increasingly separated from the rest of the world. I think it's partly, I think even the Europeans kind of woke up over the weekend when Xi pulled this.
Took long enough.
This ace, that he thought, well, let me play this card. See, and Trump's known he's had that card. That's why he's after Greenland. So, he didn't need to do that to make, but I think it was a mistake. I don't know. I'm not at the table.
But this was fun anyway. Steve, it's good to see you.
Yeah, likewise.
Thanks for sharing the 2-year view as well. Appreciate it. Steve Roth there, Federated. Thank you, sir. Let's get you an update on news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Shares of Bank of America rising after the bank reported net interest income for the third quarter that beat the average analyst estimate. Revenue came in at $28.1 billion, an uptick of 11%. B of A was also helped by the huge surge in deal making in the quarter. Advisory revenue came in at $583 million, and that was well above the nearly $447 million estimate. Dollar Tree sales have slowed after it raised prices to offset costs of President Trump's tariffs. Same-store sales rose 3.8% so far in the third quarter. That compares to 6.5% in the previous quarter. The discount retailer says earnings per share is expected to grow by a high teens percentage next year due to cost benefits. JP Morgan CEO Jamie Dimon saying he will offer to help Democratic Socialist Zoran Mamdani if he becomes the mayor of New York City. Despite voicing skepticism about Mamdani's plans to raise taxes on corporations and on the wealthy, Dimon says, quote, New York will survive. The New York City mayoral election is set for November 4th. That's your Bloomberg brief. John.
Vonnie, thank you. The best line from Jamie Dimon. Well, we survived Bill de Blasio. Gonna leave that there. Up next on the program, trade tensions with China.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us.
Up next, Tobias Adrian of the IMF, joining Bramo down in Washington, D.C. That's just around the corner. You're watching Bloomberg TV. live from New York City. Welcome to the program. Some gains on the screen this morning, up by 0.6% on the S&P, up by 0.75% on the Nasdaq. Under surveillance this morning, trade tensions with China.
We have to be careful with China. Look, I have a great relationship with President Xi, but sometimes it gets testy because China likes to take advantage of people, and they can't take advantage of us. But we have a fair relationship with China, and I think it'll be fine. And if it's not, that's okay too. We have a lot of punches being thrown, and we've been very successful.
So here's the latest this morning. President Donald Trump threatening a ban on cooking oil from China as retaliation for its refusal to buy American soybeans. With a special guest down in Washington, D.C., Lisa has more. Hey, Lisa.
Thank you so much, John. Yeah, real focus this morning on cooking oil as well as just trade tensions. I'm here with Tobias Adrian, the IMF Director of Monetary and Capital Markets. Wonderful to have you. You wrote this in your latest fiscal sustainability report, saying the first sign that the ground is shifting is the continued appreciation of risk asset prices. Markets appear to downplay the potential effects of tariffs on growth and inflation. Just how excessive does the risk rally seem to you right now, given these concerns in the backdrop?
Yeah, absolutely. So let me first point out that the first order driver for the risk rally has been the upward surprises in terms of profitability. So profits remain very strong, and the global economy, continues to grow strongly. And, that is really the underlying driver. Having said that, we do assess equity markets to be stretched, but the magnitude of the stretching is about 10%, and that is only about half of what we had in the dot-com bubble back in '99.
So do you not necessarily see the risk in AI? Is it in credit spreads? Is it in developed market debt? How much is it in maybe not the usual places of elevated equity prices?
So equity prices is one place. Another place are credit spreads and sovereign spreads that are very tight. Indeed, issuers, corporate issuers, country can access markets, and issuance has been very strong this year. I think the vulnerability is that there could be bad news at some point. For example, if profits were to disappoint at some point, or if there are other adverse shocks, there could be a repricing. We saw that, for example, in April, when markets sold off very rapidly, the magnitudes of the sell-off, was comparable to what we had seen in earlier, severe circumstances, such as the onset of the COVID crisis. Of course, we have seen a huge rebound since then, but it shows you a little bit that the reaction to news when asset prices are stretched can be somewhat outsized.
We've heard a lot about cockroaches recently, and I know that it's early in the morning, at least in the East Coast, so I apologize for this. But when we talk about First Brands, when we talk about Tricolor and the defaults, the sort of collapses there, Jamie Dimon of JP Morgan talking about there's never just one cockroach in the kitchen. And then this morning, Blue Owl's Mark Lipschultz coming out and saying, excuse me, this is fear-mongering. It's not in the private credit space. Which is the right way to look at this?
So we, of course, look very closely at underwriting standards in private credit. And, one thing I want to point out in the private credit space is that when there are any issues, typically those are worked out via what is called payment in kind. So this is sort of like, a constant restructuring. And as a result, you have seen, very little actual defaults, right? So what you're seeing is more like a workout. The two cases that you're alluding to, there was some private credit exposure, but much of that was really in the leveraged loan space more than in the private credit space per se.
So do you see a systemic risk there, or is this just sort of a one-off reality check in terms of some of the lending standards?
Absolutely. So we think that for the moment, this is fairly contained. Of course, there's some deterioration in subprime space, but in terms of magnitudes, this is fairly contained relative to the size of the credit markets. However, what we are watching is really this question, as there's more liquidity allocated to the space, could that lead to a deterioration of underwriting standards, right? So it's more forward-looking over the next 2-3 years, what is happening to underwriting standards. And one of the challenges there is the opacity, right? Can you assess that well?
I wonder what the bigger risk right now is. Is it a deterioration in the underlying economy in the United States, or is it some sort of runaway inflation on the heels of otherwise solid economic growth?
So, both sides of the dual mandate of the Federal Reserve are certainly in focus at the moment, right? So inflation remains somewhat above target, and there's a cooling of the labor market. So having the right balance to the policy approach is really key. And I think the debate is really about this balance, and there are arguments on both sides.
The idea of running off the balance sheet or stopping some of the runoff of the balance sheet, which Jerome Powell was talking about yesterday, in addition to signaling additional rate cuts this year, based on what you're seeing in terms of the excesses, maybe in some of the risk assets, in terms of the solidness of the economy, does that seem appropriate?
Yeah, so let me talk a little bit about the balance sheet and the impact on longer-term bond yields, right? Term premia certainly have been rising in recent years, and the level of term premia, say at the 10-year or the 30-year, are comparable to what we had seen pre-crisis. And we do think that balance sheet policies of the major central banks have something to do with that. So there is a relationship between the net supply, so sovereign supply, net of central bank ownership, and these longer-term term premiums.
You know, you talk about in your fiscal sustainability report that ultimately it's going to come down to countries getting their house in order, getting their books in order, stop having so much debt, try to ratchet it back. Does it feel like screaming into a void?
Well, getting back to the cockroaches, the way to get rid of them is to put your house in order, absolutely. And, I think in our personal finances, we always work on, building buffers and having reserves for rainy days. And the same is true for countries, right? You want to have the appropriate buffers. You want to have space, for example, fiscal space. You want to have space in terms of monetary policy against further adverse shocks. They may not happen. Hopefully, everything goes well and we're going to rally through the future. But sometimes bad things happen. Actually, when you think about the past 5 years, we've been through a series of negative shocks. And it is the ability to react globally and in many countries to cushion the economic outfall that then has led to fairly good outcomes.
Just real quick, what's the environment like at this IMF meeting?
I think it's cautiously optimistic. So we do have a huge amount of uncertainty in the world, right? I mean, there are major shifts going on. Measures of policy uncertainty are elevated, but of course markets are shrugging that off to some degree, right? I mean, volatility in markets is pretty much at historical averages. And so, markets take a fairly optimistic view. And so it's somewhere in between. So like the broader big picture questions, some of the uncertainties about how this will all resolve, but then also quite a bit of optimism relative to economic performance that has continued to be fairly strong.
Tobias Adrian, thank you so much for being with us here in Washington, D.C. That was Tobias Adrian, and it makes me, John, want to go home and clean my kitchen.
Lisa, thank you. You're not the only one. Thank you very much. More from Bramo through the next few days covering the IMF meetings down in Washington, D.C. Up next, we'll catch up with Chris Marinac of Jenny Montgomery Scott with Morgan Stanley results just moments away. Plus, Yahira has some of your morning movers. Bank of America shares higher on the back of strong earnings. That stock is up by more than 4%. Live from New York City, you're watching Bloomberg TV. Just moments ago, numbers dropping from Morgan Stanley. We'll get into the details in a moment, but just the headlines for you. Third quarter wealth management net revenue, upside surprise, surprise, surprise. $8.23 billion, the estimate 7.78. Equity trading revenue, $4.12 billion, the estimate 3.41. So it's just been a clean sweep of beats over the last 24 hours for the big banks on Wall Street. We'll get to Scarlet Fu in a few minutes to get you the details on all of that. Turn to the equity market. Futures bouncing back up by 0.6% on the S&P. The gains continue. They resume on the Nasdaq, up by 0.75%. Some outperformance on the Russell, up by 1 full percentage point. Let's get you some morning movers. The latest on the banks and more with Yahira. Hey, Yahira.
Hi, John. We start with the Bank of America, up 4.8% in the pre-market on a solid earnings beat. Net interest income, a key source of revenue for the bank because of its focus on commercial and retail lending, hit a record up 9%. And like all of its peers, deal making helped fuel results. Investment banking revenue blew past analyst estimates, up a whopping 43%. And speaking of deal making, another take private deal looks like it's in the works. We just talked about Papa John's earlier. Well, Grindr is up 5% after the LGBT focused dating app confirmed that its largest shareholders are exploring an acquisition that could take the company private. And we end on Dollar Tree shares. Those are soaring 6.7% in the pre-market amid some optimism for its long-term growth. That comes despite the company posting slower sales in the third quarter because it had to raise prices due to President Trump's tariffs. John?
Yahira, thank you. Thank you very much. The deal flow, it's so difficult to keep up to speed with it. This from the Financial Times just moments ago. An investment consortium that includes BlackRock, Nvidia, xAI and Microsoft has struck a $40 billion takeover of one of the world's largest data center operators as it launches an initiative to underwrite the infrastructure for artificial intelligence. The story goes on to read, the investment consortium, which also includes BlackRock's affiliate Global Infrastructure Partners and Abu Dhabi fund MGX, will acquire Texas-based aligned data centers from Macquarie Asset Management. Just showing the first few paragraphs of this news from the Financial Times.
And then you wonder why you continuously have some of these companies in the stock market continue to post gains. It's because billions of dollars are being put towards the AI infrastructure, the build out. The investment group, they're saying, has earmarked, Jonathan, $30 billion in equity, a further $70 billion in debt financing to buy and build these data center companies. And something you and I have been talking about, which is going to come home to roost next year. The electricity prices already in Texas are surging. What is this going to mean for some of these constituents? They're going to be calling their Congress members, they're going to be calling their senators and saying, you're going to have to do something about this.
There's a lot of capital sloshing around, whipping around. A lot of capital needs to go towards energy and the potential constraints that maybe we're already hitting in certain places. Let's turn back to the banks. Morgan Stanley up in the pre-market by more than 2% with the latest on the results. Here's Scarlett Fu. Hey, Scarlett.
Hi, John. Yeah, so deal makers and traders really have driven the banks to big stellar performances this third quarter, and that remains the case here with Morgan Stanley. But the extra wrinkle here, or the thing that you want to pay attention to for Morgan Stanley, is its wealth management business, which is more stable, it's fee generating, and it's not victim to the market's moves and swings. So Morgan Stanley's wealth management business reporting revenue of $8.23 billion, much higher than what analysts were looking for, which was $7.78 billion. And that was an increase of about 7%. So this is a big beat here. And of course, net revenue did rise more than 13% from the same time last year. When you look at the trading side of the business, equity sales trading, which is really the dominant part of Morgan Stanley's trading business, $4.12 billion. That is better than the expected $3.41 billion. Fixed sales and trading revenue, a smaller part of its business, but that too was a beat, $2.17 billion versus the expected $2.07 billion, and investment banking revenue also higher than anticipated. One thing that got my attention, though, was the fact that it did not seem to provision for any credit losses in the third quarter. Zero was the third quarter provision for credit losses. Analysts were looking for somewhere in the neighborhood of $97 million. So from Morgan Stanley's perspective, that seems to be they have enough money set aside right now for loans that could go bad. I'm guessing that this will come up on the investor call. JP Morgan had actually set aside more money for the third quarter, while Goldman Sachs set aside less. Expenses, non-interest expenses, did come in higher than anticipated. And this is something that's been consistent with the banks that have reported, certainly from Goldman Sachs. $12.2 billion for non-interest expenses. Analysts were looking for just under $11.85 billion. And compensation expenses, which tends to be the most, the heftiest part of expenses for banks, was $7.44 billion, also higher than what analysts had anticipated. But it is that wealth management number, John, that investors and analysts are fixated on, and that is why you see the stock moving up about 2.5% in the pre-market trade.
Scarlett Fu, thank you, Scarlett, with the latest. Let's unpack some of that. Chris Marinac of Janney Montgomery Scott still with us. Chris, Scarlett was going through that important wealth management number. That's a $500 million beat. Now, Chris, can you just explain why that number is so important to this bank?
Well, it's the highest margin business they have, John, and it's very much recurring revenue. So the more business of that you can have, it's going to sustain this revenue growth and margin for a longer time. It's going to be less volatile than other parts of the trading and investment bank business. So I think that wealth business continues to compound over time, and that's why the investors focus on it to the degree that they do.
Chris, Scarlett mentioned the provision for credit losses, zero. Chris, I just wonder what your reaction is to that compared to what we saw from the likes of JP Morgan yesterday.
Well, I'm a little surprised, but by the same token, they have a lot of capital and a lot of earnings. I also think the mix of loan growth could be very much skewed towards a wealth management customer that does not have much risk. They may also have, and they seem to have, relatively benign charge-offs in the quarter compared to last. So I think that also went into the calculus on no provision. But even if they would have had a provision, they still would have had an excellent quarter, beat expectations, et cetera. So in this particular quarter, it may not matter. I would prefer to see more reserves than zero, but I do think that there's flexibility, and particularly I think the types of loans they grew is part of why they did not have an increase.
Chris, now that we got Morgan Stanley, basically we have all of the banks reporting, the top banks. What are your initial thoughts so far about the industry as a whole?
Well, it's in very strong footing. We continue to build capital. I really think that the credit picture continues to be very stable and benign. Yes, we have problems that are percolating under the surface. I think these incidents that we've seen the past 4 to 5 weeks will most likely continue here or there. You know, corporate bankruptcies are higher than 2019, but only by a few percentage points. It's not that much of a deterioration, but generally speaking, we'll see more issues as the temperature comes down on credit. But I still think that overall, the banks can make a lot of money here, continue to get paid more than they have because the stocks are very inexpensive, and then continue to roll into a very strong year end.
I guess what I'm asking and trying to get at is, what would be your top pick after seeing the latest results?
Well, I think the regional banks still have a lot more to go. I think Fifth Third is in a very interesting position given the Comerica news, and also that I think the market has moved on from their credit incident pretty quickly. First Citizens, FCNCA, is very interesting. It's a company that has been digesting Silicon Valley for 2.5 years and not getting a lot of love. They are buying back stock hand over fist and continue to do quite well, growing the core business that they've always had, in addition to the old CIT and Silicon Valley. So that, I think, is an up-and-coming regional bank. We also would pay attention to Wintrust, WTFC, and also feel very highly about the Pinnacle-Synovus merger that is coming down the road the next few months.
Chris, just finally, it's a question that I've thought about before, and forgive me if I've asked it before as well. It comes up repeatedly, I know. But Chris, when is a regional no longer a regional, as they all start buying each other and they get bigger and bigger?
So I guess it probably crosses 300 billion would be the line in the sand, maybe 500 billion. You know, I think we think of the Truists and the U.S. banks and PNC in a different category than Fifth Third and Regions and some of the other more ordinary regional banks. But I still think that from a size perspective, we have to be cognizant of the quality of how those companies go. That's going to be the secret sauce, is getting larger with more scale, but also keeping the quality very much intact.
Chris, are there specific regions that are looking more attractive than others right now?
So the Midwest continues to do really well because of the onshoring in the country. I think that is a region that I think will be better than folks realize. The Southeast still has the demographics. You still have the tax benefits being in Texas and Arizona and some of those states as we have migration away from California. Florida continues to be quite important. So I think that sort of Midwest and Sun Belt would be the top areas, but I would not forget other parts of the country because there's still a lot of people in the Northeast. There still is a lot of infrastructure in the Northeast that can still do well and perform in 27 and 26.
Hey, Chris, it's good to see you. As always, thank you, sir. Chris Marinak there of Janney Montgomery Scott. Thank you. Just moments ago, we got those numbers from Morgan Stanley. Scarlett Fu went through the numbers well. Fantastic, as always. Beat. You saw it on wealth management. Net revenue, $8.23 billion. The estimate was $7.78. That's a big beat. Equity trading revenue, $4.12 billion. The estimate, $3.41. That's why the stock is up by 3.5%. These are the major players on Wall Street. When you start to talk about the regionals getting together, and when I said to Chris, where do you want to be? What's the attractive region at the moment? He went to politics almost straight away and talked about the policy from the White House shaping the kind of regions you want to be at because of the activity you'll see there.
Well, at the same time, what we were just talking about, this massive scoop from the Financial Times about how you have this consortium with billions of dollars to take over an AI data center. Where's that all happening? That's happening in Texas. Where's all the wealth generating from? Individuals, high net worth people. They're coming from New York down to Florida. They're going from California to Texas to Arizona. That's potentially why you're so interested in the regional players. And similar to what Gerard Cassidy was talking about, now you have really a starting gun when it comes to these regional players and the consolidation. That's going to benefit the entire banking industry.
The banks have been flying all year. We're up again this morning by 3.6% if you're looking at Morgan Stanley. As we wrap up earnings season on Wall Street with beats, pretty much across the board. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. And let's recap. Shares of Morgan Stanley, as you say, rising after topping earnings expectations for the third quarter. Net revenue of $18.22 billion was well above analyst estimates, plus another beat on investment banking. CEO Ted Pick saying in the release, consistent execution of our strategy led to record revenues. An investment consortium that includes BlackRock, Nvidia, Microsoft and xAI is taking over one of the world's largest data center operators. Texas-based Aligned Data Centers will be acquired from Macquarie Asset Management. The group will expand Aligned in the coming years to double its data center campuses in the US and Latin America. And Walmart teaming up with OpenAI, the retail giant will enable customers to browse and buy products directly on ChatGPT. Shoppers will be able to shop Walmart and third-party sellers' products directly on ChatGPT by clicking a buy button. The function launches in the fall. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next, the Federal Reserve's balancing act.
There really isn't a risk-free path now since it appears that inflation is continuing. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined.
Chairman Powell, without much data, leaving the door wide open for another interest rate reduction at the end of the month. We'll catch up with Tony Rodriguez of Nuveen in just a moment. Live from New York City, you're watching Bloomberg TV. Clean sweep of beats for the big banks on Wall Street in the last 24 hours. The latest just moments ago, Morgan Stanley up in the pre-market by more than 4%. Fantastic live blog driven by Bloomberg News. On the Bloomberg terminal, this came from Paige Smith. I'm not noticing a single metric that came in below Wall Street analyst expectations for this name. Morgan Stanley up nicely in the pre-market as we wrap up earnings on Wall Street. For the broader equity market, bouncing back, we look like this on the S&P 500. Equities higher by 0.6%. On the Nasdaq, up by 0.8. In the bond market, 2-year, 10-year and 30-year bond yields shaping up as follows. Yields down across the board, down about a single basis point on 10s, just north of 4%. We're going to squeeze in a lot of Fed speak over the next few days going into the quiet period. A lot of attention on the Federal Reserve going into that quiet period ahead of that next meeting with very little economic data.
I'm sure they're happy they're entering this quiet period because what can they say as they're in a data desert? What has really changed since the end of September? The Fed seems to be stuck in time. That's the sense I got from Jay Powell yesterday. Basically, the bias is still to the labor market, as you've been talking about. The one piece of data they are definitely going to get is CPI. And how uncomfortable is that going to be for the Fed to potentially have a very hot CPI print and not know the latest labor market reporting because the government is still in shutdown mode? Based on the estimates, that CPI print could well have a 3 handle. That number expected to drop on October 24th. Delayed, of course. It was meant to come out this morning. Under surveillance this morning, the Federal Reserve's balancing act.
There really isn't a risk-free path now since it appears that inflation is certainly running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined.
So here's the latest this morning. Fed Chair Jay Powell reiterating the lack of a risk-free path for the central bank as its dual mandate creates tension. Tony Rodriguez of Nuveen writing the following. Barring surprises in the data, we expect the Federal Reserve to cut interest rates by another 25 basis points at their meeting later this month. Tony joins us now for more. Tony, good morning.
Good morning, John. We're going to be with you.
Just want to run through that line from Chairman Powell. He's mentioned it a few times in the past few months. There really isn't a risk-free path now. If he believes that and continues to cut interest rates, what is the risk that he's putting more priority on versus the other?
Well, I think right now they're almost getting a little bit of a free pass on this October meeting because there is a little bit of a lack of data. So that hasn't really challenged that view of what to do. And they can placate kind of all the political pressure because ultimately they are telegraphing that they're expecting to be lower over the next few quarters. So taking the move now versus waiting for the next meeting in December, it's kind of a freebie to take it now wait for maybe the data to hopefully ultimately come out from the government and see if that supports that move or not. Then they can delay December, continue in December. But given that they are modestly restrictive now, given that we're seeing some softening in the labor market, unemployment's up almost 1% over the last year, still at a low level, I think it gives them kind of a free pass to take the cut here in October, see what the data brings after that.
This isn't true of the whole committee, but certain members of the committee are very spooked by what's happened with payrolls. And it's been a huge downshift. We've gone from averaging 200K to averaging something closer to zero over the last 3 months. The Fed chair yesterday said you're at a place where further declines in job openings might very well show up in unemployment. Now, we haven't seen that so far. We've seen a huge downshift in payrolls, but actually unemployment stay close to the low fours. Does that raise questions about whether this is structural or cyclical and what is just going on here, what exactly is going on with the labour market?
Oh, it definitely raises questions. And we do think that the preponderance of it is on the structural side because immigration has really gone through an absolute shock. We've gone from, what had been a run rate of 1 million, kind of peaked at 2, but now is at 0, maybe net negative. So that clearly reduces the amount of jobs that we need to create to keep that unemployment rate steady. Ultimately, the Fed's going to look at that unemployment rate, and as long as the job numbers are sufficient to keep that rate steady, they'll be fine with that.
What's sufficient? And how much has that changed? What is sufficient now?
Yeah, and that has changed. So what we would have argued had been, call it 150 to 175,000 jobs per month type of number. Now we think is more in the ballpark of 50,000 jobs plus or minus. That's the deceleration in immigration, along with that longer secular move of demographics that has been lowering that, over the last decade or two.
Tony, why wouldn't they go on hold later in the year when they actually have all the data? This is a Fed that's gone out of their way time and time again to say they're data dependent, and then all of a sudden in the October meeting, they're not going to be data dependent?
Yeah, and I think the answer to that is really around the fact that if you took political pressure off the table, I think that might be the argument that carried the day, and they might wait until that next meeting.
So you think they're acting because of politics?
I think political pressure is part of the calculus. You've seen it in a lot of the shifts in the commentary from a lot of the Fed members, some voting, some not. But clearly the narrative has shifted. And in part, it's a little bit in trying to maybe help preserve the independence of the institution by not engendering unnecessary political pressure by being in this October versus December move, when really ultimately they go from moderately restrictive to a little bit less restrictive. It's not really a game changer from a stimulation perspective to the economy. So take the move, keep the pressure, down a little bit, maybe helps preserve the institution, wait for data to come out.
But it's a very low unemployment rate. So when Jay Powell talks about this weakness in the labor market, he's just talking about this low hiring environment, but it's also a low firing environment. Isn't this the moment where you would say we should wait for confirmation of data?
Yeah, what I think has happened is that since the unemployment rate's gone up about 9/10 over the last year, we would say maybe 4% is the natural rate. You're a little bit above that. Our forecast is for 4.5% by the end of the year. So you're starting to bump up against a level that does become worrisome for the Fed. So if we were to see 4.5 sooner than year end, possibly see above that, then I think you run the risk of kind of that self-reinforcing move of a more quickly rising unemployment rate. So getting ahead of that by at least getting closer to neutral in terms of the funds rate is what I think the balance of risks argument leads to, meaning a cut here in October.
Tony, what do you think the market's positioning for? Let's talk about that. 10's down at 4, 2's breaking 350. What does that tell you at the moment?
Yeah, I think, they're certainly pricing in the cuts, but I think you're also getting a little bit of insurance on maybe more downside to the economy. So you could argue that maybe gold is a little bit of that if you don't think it's a debasement trade only. I think in the bond market what you're seeing, because ultimately we think long end rates are fair here and might be even a bit higher given all the fiscal spending, the structural term premium increase. So I think it's telling you we're trying to buy some insurance against a more significant slowdown, given the potential for some of these exogenous shocks from trade, politics, et cetera.
There was some nervousness for a bunch of reasons back in April about extending duration. When you see moves like this, sometimes they just feed on themselves, that maybe people start to think, bonds do work. maybe now's the time to extend duration. Are you pushing back against that?
Yeah, we don't think it's a time to extend duration. We think that, again, we're at fair value, but we do think that duration will work as a hedge. If we're wrong, we're not calling for recession. We'd say probability of recession maybe 30%. But if, in fact, that starts to rise, you see greater weakness in the job market, we do think duration then will play its traditional role of a solid hedge in a weakening environment, because then we'll see a more aggressive Fed. Then I think we'll see a 10-year that could get down to below 3% in a real, true, deep recession. Our calls avoid a recession. The 10-year hangs around 4%. So there's no real big money to be made on the duration play.
As they start to cut interest rates for the riskier parts of markets, are you identifying some credit stress that would be alleviated by lower interest rates?
We are, and that's primarily because we've been at this higher level of rates now for a couple of years. So for the large indebted kind of lower quality companies, that is something they can handle for 6 months, 1 year, 2 years. The longer it lasts, the more difficult it is. So taking some of that pressure off of that kind of company and having lower end consumers maybe be able to refinance a home, that kind of thing, that can be supportive of both consumer spending and corporate credit. Now, both are in good shape, consumer spending and corporate credit, but this will help. I think lower rates would help prevent maybe that next shoe to drop in terms of weakness.
We've had two shoes drop. First Brands, Tricolor, came up on the call yesterday with Jamie Dimon at JP Morgan. He talked about cockroaches. Annmarie brought this up a little bit earlier as well. Worried there could be others. Are you worried about that?
Well, we definitely think there's going to be more cockroaches, right? There is going to be more credit stress. We're expecting a rise in the default rate, but we're going from a very low level to what we think will be more consistent with historically average levels. So we don't think it's going to become a problem for, say, the financial institutions in terms of their asset quality or for the broader economy in terms of recession. You don't think it infects public market sentiment to some degree as these headlines start to come to the surface? Yeah, I do think that, for example, when we talk about risk premiums, which are clearly at, whatever you want to call it, rich, frothy, elevated levels, we do think you can see some widening in risk premiums as a result of that kind of, one cockroach shows up, another one shows up. You get a little bit of weakness for sure. But again, we don't think it's kind of the cycle is turning into a negative credit cycle here.
That would be the worry. Tony, it's good to see you. Thanks for dropping by. Tony Rodriguez there of Nuveen. That full quote from Jamie Dimon yesterday. I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this one.
He's sounding the alarm. A number of banks are sounding the alarm about these concerns. They're not saying it's systemic. It's idiosyncratic to potentially some bad moves, a bad bet. But the issue is, if there's one, are there others? And the problem is you just don't know until you know. And this is going to be potentially an issue for 2026.
Up next on the programme, we'll catch up with Alex Altman of Barclays, Gil Luria of D.A. Davidson, Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management. The third hour of Bloomberg Surveillance is coming up next.
The real focal point right now should be on earnings.
Earnings continue to be the North Star.
Earnings are strong, but valuations are also very high.
Equity investors just forgot about the idea that there might be some short-term pain involved.
There are still risks on the horizon.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell. Your scores look like this. Equity futures, session highs up by 0.6% on the S&P. On the Nasdaq 100, up by 0.8. Two more banks reporting this morning, two more beats. Bank of America, Morgan Stanley in the pre-market higher by 1% for Morgan Stanley. Bank of America up by 5.5 and just beats across the board.
Beats across the board. Looking at Morgan Stanley, too, right now, they reported, Jonathan, revenue from trading stocks up 35% to $4.12 billion, surpassing estimates. This is huge in terms of how they want to take on Goldman Sachs in that division. And when I look at these banks, all I keep thinking is the policy in Washington, how much that's fueled them. Some of the chaos and uncertainty around trade, that was great if you're on a trading desk. And the fact that you're in this deregulatory environment, how much has that helped in terms of these advisory fees when it comes to the IPO market? These banks are crushing it, partially because of what this administration is doing.
Goldman the same yesterday. Record third quarter revenue. We've seen this across the board. Citi beat in every single division. JP Morgan beat. We saw it again this morning. Bank of America, Morgan Stanley. So we can park the bank earnings. No problem there, at least for now. You get some calls later. Now we can focus on trade again. 9:15 Eastern Time. Ambassador Greer, alongside the Treasury Secretary Scott Bessent, on trade. And it's the trade tension that has whipsawed this market over the previous 3 sessions. I've gone through this a few times. Think about the last 3 days. Friday, the worst day for the S&P since April. Monday, the best since May. And yesterday, an almost 2 percentage point swing on the S&P 500 from session low to session high.
And all dictated by President Donald Trump's Truth Social post. Friday, it was about potentially 100% tariffs on China, because what China did and coming out in terms of what they plan to do in terms of export controls on rare earths. Then on Sunday, he said, I think me and China, we're going to get to a good place. Potentially, there'll still be this meeting. The market viewed that as taco. Well, it's not taco right now. Trump is just negotiating out loud leading into this meeting. So you are going to see more days like this. What is it going to be? Ports, rare earths, cooking oil, soybeans, everything is on the table.
You know, I hate the phrase taco. If you think about things, remove yourself from financial markets.
Fully taco.
Just think about where we've been since the start of the year, what happened in April, and how much higher tariffs are now than before the president went into the White House. Now, if you call that chicken and gal, just how much higher are tariffs now versus where they were at the start of the year?
Or ask the Iranians, they would certainly say he does not taco. I would go back to what Ethan Harris said during all the trade headlines in April. Trump always tries again. He anchors it to the extreme. You've talked about this. Puts the bias and anchors to the extreme, and then sees where he can get away with in terms of negotiating. He came out in April with sky-high tariffs, but yet then the world sort of blanked and accepted the level we are at now, which is definitely double-digit tariffs, higher than we were this time last year.
A multiple of where we were, and stocks are still close to all-time highs. The S&P up by 0.7%. Will it come back to bite? We'll see. Coming up on the programme, Alex Altman of Barclays as stocks are edging higher, Gil Luria of D.A. Davidson as the AI chips race is heating up, and Tiffany Wilding of PIMCO with Fed Chair Jay Powell signalling an October rate cut. We begin this hour with stocks bouncing back. Alex Altman of Barclays writing the following. The period of the year, this period, is typically when small investors accelerate their purchases of stock. And that is not a trend I'm willing to fight. Alex joins us now for more. Alex, good morning.
Good morning.
Do you see a lot of that already?
We are. We're seeing effectively record amount of option volume, with a lot of it being driven by small investors. You can look obviously across the meme cohort. We just had the meme ETF that was mothballed and has come back to life now. I think it's pretty clear that we're getting sprinkles of 2021 all over again.
Is Friday a good example of that? When we had massive options volume and they weren't rushing for downside protection, they were actually looking to play the bounce back of the equity market.
Yes, but I think there's other things which you've just highlighted. You know, you've got a pro-risk friendly administration. You've got a deregulatory environment. You've got an AI arms race that is going on. You've got a weaker dollar as well. You've still got record inflows by foreign investors into the US equity market. So it's not just retail investors. I think people love to use them as a catch-all, as an excuse as to why stocks are going up. But ultimately, there's lots of verticals. Also, let's not forget that the 401k plans are still buying stocks in their life plan 30s or whatever you want to call it every single week. And as long as people still have jobs, as long as we're not seeing those firings, that passive inflow is coming too.
We don't throw mud at retail investors on this programme. Just to be very clear, I'm not one of those, because I think retail has done a better job than some people on Wall Street have since the pandemic. They've leaned into investing. They've had a bias to buy in a way where I think Wall Street's been reluctant. For the people that sat out the rally since early April, and it's been a really fast move, are they being sucked into this into year end, trying to catch up on performance?
So it's a really good question. And the short answer is not yet, but I think that we're going to start seeing it. So if you look at, for example, the hedge fund cohort, represents 7, 8, 9% of the market. Their beta to the market is actually quite low at the moment. And what's happening is that's offsetting the fact that their net exposures have increased. And so what I mean by that, it looks like they're very exposed to the market, but the stuff that they own is still very high quality, high profitability, large cap. And obviously we've talked about small caps on this program before. The fact of the matter is that these kind of positioning biases, which is pretty crowded, legacy from the higher for longer environment is effectively not what's going to work. So I think that's what's effectively going to force them to chase this market, because they are long, but are they long the right stuff?
If everyone's chasing the market, if we get a down day, then don't you just expect absolute another record to beat on the next day, like we saw Friday to Monday?
Well, look, I think a lot of what we saw, for example, on Friday was driven by the vol control verticals. And by that, I mean, we had this period of very low realized volatility. We had a 2.7% move in the S&P in one day. And that triggered a lot of systematic selling. On our estimates, systematic exposures to the S&P or just to US equities dropped from about the 98th percentile to about the 72nd percentile over a 2-day window. That was, on our count, about the top 15 or top 20 2-day move lower in systematic exposures that we've seen over the past 10 years. So you think about how quickly we just flushed out some of the risks that needed to sell, and the S&P only went down by less than 3%. That, to me, is a clear indication of the kind of bull market that we're in right now.
Are people starting to prepare in the options market for what can happen at the end of the month when it comes to the meeting of Xi Jinping and President Trump?
Yes, but it's not just because of that. We've obviously got a Fed meeting as well on the 29th, and we've got a confluence of mega cap earning all happening in that 1 week. So yeah, you can see there's a big kink in the vol curve. That's been prevalent really for quite a while now. And obviously we've had a parallel shift up in all of the vol curve as a function of this tariff blindsiding.
But are people looking for the upside or the downside?
Well, that we don't know, but we can see it effectively within the options skew as well to a degree. So skew's quite high at the moment. And what I mean by that is that the puts trade relatively expensive versus the calls. Why would that be? Well, a lot of people say, oh, people are reaching for protection, people are bearish. Actually, it's more of a reflection of the fact that generally skew tends to steepen when people are long, which kind of makes sense. You only really buy protection if you've got something to protect.
Earnings season hasn't started yet. Earnings season starts in 2 weeks when we get the major tech players reporting. Just got this note from HSBC. Check this out. Upgrading Nvidia to buy from hold, citing the ongoing growth of artificial intelligence, raising the price target, street high 320 from 200. They're looking potentially for upside of 80% from yesterday's close. And the quote from them is room for significant full year 27 earnings upside. Alex, I've had a lot of people come on the programme worried about valuations. And given the strength of the balance sheets of some of these major tech players, just how much oxygen is actually left in some of this trade?
I think there's probably quite a lot. It depends really on how effectively you want to think about the narrative. And let's be very clear. We can talk about valuation all day, and if you'd use valuation as a reason to not buy equities this year, then it's been a struggle. But at the same time, we can talk about things like gold. Right? So gold, what is the valuation of gold? Well, S&P's underperformed gold by 30% this year. So the point being is that valuation, I think, becomes a bit of a murky ground. What we're in right now, and kind of tying it back into retail, we've got to accept the fact that we're in a narrative-driven market. And I'm not going to say that valuation doesn't matter, because it does matter enormously. But when you're in a narrative-driven market, you can deviate quite spectacularly from what the valuation-driven framework would tell you to.
I see people joking about it. I got a message just moments ago from a Bloomberg subscriber. I'll keep their name personal, anonymous. They said this, breaking, and I've seen this joke before, OpenAI to partner with OpenAI to help fund OpenAI, OpenAI up 90%. We've seen those kind of deals being made. Are you noticing anyone being pushed out of the market by those kind of deals? Are they scared of those deals? Or do you see those deals actually just as another reason to draw people in?
I would say it's a very bifurcating topic. So you've got some individuals. We actually had a big hedge fund dinner last night, and we were discussing this. And show of hands, how many people think we're in a bubble? How many people don't think we're in a bubble? And there's a lot of ambivalence exactly to that point, because yes, there's enough grey hairs in a room to remember the circularity of say the .com bubble. But similarly, you've got to acknowledge we're talking about businesses that are cash volcanoes as well. And so the analogy is this more like .com? Or is it more like the railroad construction? And ultimately, yes, we're building acres of data centers, but at the end of the day, that data centers will get used for something. And as long as it's being predominantly financed by internal cash flow, and not all, we're clearly seeing a massive uptick in IG issuance, then actually it's less of a problem. So I think there is a lot of runway. And again, I think we've just got to distill it back to what kind of investing environment we're in right now, acknowledging that valuations can get very deviated from what we would consider fair, and accept the fact that the flow of funds and narratives can run for a lot longer than people think.
Can you go through the show of hands again? When you ask them, hands up, who thinks we're in a bubble, how many of the people with their hands up also thought they should be buying the said bubble?
Well, back to my point about hedge fund positioning, in terms of there is still a large degree of skepticism as well. And also, you've got to remember that a lot of hedge funds, the industry's changed a lot. If you think about the vast majority of AUM is now tied to, in some way, shape or form, relatively low net exposures, relatively factor neutralized. So even if in a case a lot of these individuals would have wanted to participate in it, it's just not really the mandate anymore for a lot of that part of the industry. And then when you talk about the mutual fund and long-only industry, consider the fact that they often have weighting caps on their portfolios. So the concentration risk in the S&P is also another headwind in order to perform as well as you would want to during, if we are indeed in a bubble. Just for the record, I don't think we're in a bubble. I don't think we're there. And if we are, it's so early stage that I think. How
would you know? What would you see? What are you looking for?
At the very least, a broader acceptance or an embracing of this narrative. And right now, I would say that we're nowhere near there. If you want to talk about bubbles, let's talk about gold. Right? So no one I talk to talks about a gold bubble right now. And yet, simultaneously, think about it. As I said earlier, S&P's underperformed gold by 30% this year. 30. The only other times that's happened has been during deep equity bear markets, 2002, 2008, and 4 periods in the 1970s on an annual basis. And we haven't even finished the year yet, right? So I think when we want to talk about bubbles, and again, it's dangerous to compare like relative value when it comes to bubbles, but I would say that actually if there's a bubble brewing, it's more in gold than it is in stocks right now.
Interesting. Alex, thank you, sir. It's good to see you.
Thanks very much.
Alex Altman of Barclays. Gold higher by 1.3% this morning. Stocks too. We're high about 0.75% on the S&P as we count you down to the opening bell. Let's get you some news elsewhere, some top stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Let's recap those banking beats. Bank of America reporting third quarter earnings that beat. Investment banking revenue up 43% to $2.05 billion, better than the $1.65 billion analysts had expected. M&A advisory fees at Bank of America soared 51%, and net interest income rose 9.1%. Shares of Morgan Stanley, too, rising after topping earnings expectations for Q3. Net revenue of $18.22 billion, well above the estimates, plus another beat on investment banking. CEO Ted Pick saying in the release, consistent execution of our strategy led to record revenues. Salesforce is planning to invest $15 billion in San Francisco over the next 5 years to strengthen the city's dominance in AI. CEO Mark Benioff posted on X that the investment will help, quote, build a greater, safer city for everyone. The investment will go towards a new hub on the company's San Francisco campus to support workforce development and training. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, the Morning Calls Plus. Gil Luria of D.A. Davidson as the AI chips race heats up. That conversation up next. Live from New York City this morning. Good morning.
In very strong footing. We continue to build capital. I really think that the credit picture continues to be very stable and benign. Yes, we have problems that are percolating under the surface. Generally speaking, we'll see more issues as the temperature comes down on credit, but I still think that overall the banks can make a lot of money here and then continue to roll into a very strong year end.
It's fair to say, based on the quarterly results of the last 24 hours, that the banks are making a lot of money. Chris Marinak of Janney Montgomery Scott there, following the bank earnings this morning. Decent, solid numbers, more beats from the likes of Morgan Stanley and Bank of America. It follows the same story yesterday from Goldman, from Citi and from JP Morgan. Equity futures shaping up as follows into the opening bell, 1 hour and 13 minutes away. Equities up by 0.8% on the S&P, on the Nasdaq up by 1 full percentage point. That's your bounce right there into the cash open. So that's the price action. Here are the morning calls. First up, Piper Sandler raising its price target on Citi to 110, citing a better than expected core third quarter. That stock is up by 1.4%, up again today. Your second call from Barclays raising its price target on Goldman to 850, citing investment banking activity on the, quote, upswing, up another 1.6% for that name in early trading. And finally, check this out. HSBC upgrading Nvidia to a buy with a street high price target of 320, expecting significant earnings upside on chip momentum. That stock is higher by 2.54% going into the cash open. Let's stick with tech. ASML shares rising after its orders beat expectations with AI demand staying strong. Joining us now, Peter Alstrom of Bloomberg joins us now for more. Pete, welcome to the program. What do you see from ASML, and what does it mean for what we could see elsewhere from some of these major players?
Well, ASML, of course, makes chip-making equipment, so it sits sort of at the beginning of the supply chain, sells its machines to the likes of TSMC and Intel and Samsung, who then go on to sell their chips to NVIDIA and the rest of the AI universe, including OpenAI. So what ASML said is that revenues for the quarter were actually a little bit light. They came in at 7.5 billion euros. Analysts were expecting 7.7. But what they did is they talked about their bookings, which were higher than expected. They said the bookings were 5.4 billion euros compared with estimates of 4.9 billion. So that gave investors some optimism that, in fact, the purchases of their chip-making machines are picking up a little bit. And the CEO, Christophe Fouquet, talked a bit about this. He's seeing strong demand from the AI customers in particular, so they're able to sell into this market. Their EUV machines are really at the top of the market. Those have been very big sellers for them, especially with the likes of TSMC. A couple of their customers have had some weaknesses, Intel in particular, but now Intel's been able to get a bit of momentum, including with that investment from the U.S. government. So they've been able to make some investments. It sounds like they're going to also be a bit more aggressive in terms of their purchases of ASML machines so that they can make these chips to supply this demand going forward.
Peter, I'm so pleased you went there. I think that's a really important dynamic to be thinking about here. There is a massive effort right where you're sitting to build out domestic fab capacity in the United States of America. And Intel, if the White House has anything to decide, is going to be a key part of all of that. Now, Peter, I wonder what that means for where the orders come from for the likes of ASML and where maybe there might be some tension in the future with the likes of ASML and maybe certain countries in Asia.
Yeah, that's exactly right. For many years, the U.S. government, U.S. companies sort of allowed the most advanced chip production to go to Asia, to Taiwan in particular, also to South Korea. Now what we're seeing is this very concerted effort in the United States to bring some of those companies here. They're the same companies. TSMC is building its fabs here in the United States. Samsung, SK Hynix are all building their fabs here in the United States. We're also seeing ASML benefit quite a bit from China's investment. Chinese companies can't buy the most advanced machines. They can't buy the EUV machines, for example, that are making the chips for NVIDIA and for Apple, for that matter. But they can buy other machines from ASML that are a little bit less sophisticated. That demand has been very strong for them. They think that that's probably going to taper off in the future. But there are investments being made here in the United States that should benefit. TSMC is certainly one of those. They're by far the most advanced producer of these chips. But Intel, as you mentioned, Intel is coming on. They're making some progress. There's a lot of hope. There's a lot of investments now in Intel and it being able to reclaim some of the past glory and get back to chip production.
A lot of hope and a lot more money based on the investments of the last month. Peter, appreciate the update. Peter Elstrom there of Bloomberg, live in our Washington, D.C. bureau in the nation's capital. Gil Luria at D.A. Davidson joins us now for more. Gil, welcome to the programme, sir. NVIDIA centre stage in the last 5 minutes. Big upgrade from HSBC. Big price target too. Street high, 320. Gil, when you think about things regarding NVIDIA, is it still the only game in town, or does AMD provide a bit of an alternative?
NVIDIA is not the only game in town, but will continue to be the main game in town. All of its customers are trying to diversify. They've been trying to diversify, but it's hard because NVIDIA continues to introduce product at such a fast pace that it's very hard for other products to even be comparable, which is to say, Google especially, and some extent Amazon, are going to increasingly use their chips more. That's Broadcom. And then all of these customers, Microsoft, Amazon, Google, Meta, XAI, are going to have some AMD componentry just because they want to have diversification. But unless the AMD chips catch up in performance next year to NVIDIA's chips, that is going to be a small proportion. One way or another, even if AMD's chips are great and Broadcom continues to generate a lot of good ASIC chips, the custom chips for these customers, NVIDIA will continue to have overwhelming share of this market for a while longer.
These companies continue to chug along, stock prices higher. We're seeing upgrades like this morning of HSBC at the same time where the rhetoric between China and the United States is really heating up. How are they going to get potentially caught in the crosshairs between Washington and Beijing?
They already have. NVIDIA, in fact, has missed its last 2 quarterly reports because of China. China is somewhat out of the numbers. It's not completely out of the numbers, but it's somewhat out of the numbers. And unless the US and China can arrive at some sort of broader framework for an agreement, NVIDIA's sales into China are going to be very much impacted for a while longer, and as long as that's happening. They have been all year, and it's been a drag on NVIDIA already. Having said that, the market is growing so fast right now that NVIDIA can probably live up to expectations without significant contribution from China. If China does come back, which it may not, NVIDIA can do even better. But the demand right now is so big that NVIDIA can probably do okay even if the demand from China is limited.
Who can't do as well as NVIDIA if the demand from China is limited?
It would impact NVIDIA more than any other company, but also AMD and Broadcom and much of the rest of the ecosystem that sells into China will be impacted. And long term, whether or not there's a full decoupling from China, we're already well on our way to having a much different supply chain than we had even a couple of years ago. You were just having a conversation about the fact that we're going to have to build a lot more of the supply chain in the United States. It's going to be a long process. It's very complicated. It goes well beyond Intel and TSMC. It goes through their whole supply chain that we will be gradually moving into the US and into other countries that are not China and not Taiwan in order to make the supply chain more robust. It's a matter of national security. And one way or another, we're having some level of decoupling from China. Whether both sides agree to that or not, companies are already understanding that there's never going to be stability in this relationship, so they need to diversify.
Gil, we've got to go. Appreciate you jumping on. Gil Luria there of D.A. Davidson. Following this upgrade from HSBC and frankly, NVIDIA, a big bull now on this stock, looking for 320. That price target increased from 200, implying upside of 80% from the last close for NVIDIA. That stock is higher now by 2.5%. Up next on this program, Tiffany Warnig of PIMCO as Fed Chair Jay Powell signals an October rate cut. Plus, Yahira has some morning movers for you. Morgan Stanley, Bank of America, both rising on big beats this morning. Morgan Stanley up 4.6%. Bank of America up by close to 5%. The opening about 60 minutes away. The price action shaping up as follows. Higher by 0.7% on the S&P, gaining by almost 1% on the Nasdaq 100. An outperformance from the small caps this morning. The Russell 2000 higher by 1.1%. Let's get you some single names. Lift the lid on the index with your morning movers. Here's Yahira. Hey, Yahira.
Hi, John. CEO Ted Pick must be very happy right now because Morgan Stanley just stole the spotlight from Goldman Sachs with revenue from trading stocks surging 35%, beating Goldman in an area it long dominated. And aside from that, Morgan Stanley saw beats across the board thanks to booming investment banking and wealth management. Over at Bank of America, net interest income, a key source of revenue for the bank, rose to a record up 9%. Both of those stocks up 4.4%. Meanwhile, as we wrap up the big bank earnings, we move on to the regionals. PNC Financial, those shares are falling 3%. Despite beating on both the top and bottom lines, and the credit picture looks solid for the bank. PNC set aside less for future loan losses than analysts predicted, and it also posted fewer bad loans than predicted for the quarter. And we end on Dollar Tree. That stock is surging in the pre-market, up 7.5% amid optimism for its long-term growth strategy as it put out new metrics. And that is despite the company posting slower sales in the third quarter because it had to raise prices to offset President Trump's tariffs. John?
Yahira, thank you. Thanks for the update and thanks for this morning. Speaking of the president's tariffs, we've heard from the Treasury Secretary Scott Bessent just moments ago saying this about China going into negotiations month end where we should see a meeting between the two leaders of the respective countries, the US and China, President Xi and President Donald Trump. Scott Bessent saying optimistic on China. We are now communicating, also saying at the same time there's lots of levers to pull that could damage the country.
And we're going to get an update on that at 9:15 when he is standing alongside Jamieson Greer. These two individuals are having those conversations with their Chinese counterparts, potentially building out a potential deal that President Xi and President Trump can both walk away with in South Korea as a win. We have to remember, though, this might bleed into 2026. If you don't think that there's going to be issues that continue to arise from this relationship, then you'd be remiss. Remember, it took 18 months and Trump won just to get one agreement done when it comes to purchases. And this time, so many more issues and really deep policy issues like fentanyl that cut to the president's base are on the table.
The latest headlines from the Treasury Secretary, Scott Bessent. More still to come. As Anne-Marie's mentioned a few times, 9:15 Eastern Time, so about 43 minutes from now, you should hear from the Treasury Secretary alongside Ambassador Greer, attempting to get some clarity here on just where these trade talks are going into that meeting with the two leaders. The Treasury Secretary saying this morning that meeting should be a go. Your equity markets in this session highs up by 0.75%. The opening bell about 1 hour away. As we turn to the Federal Reserve, Chairman Jay Powell signalling the US Central Bank is on track to deliver another quarter point interest rate cut later on this month. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, the chairman has spoken, and it is basically what the markets wanted to hear. This was his last appearance before the blackout starts on Saturday. We have some other Fed officials coming up this week, but basically now that we know where Jay Powell is, we pretty much know where the Fed is going to come out on October 29th. That was his main point, that the Fed remains on track to cut rates then. There is still a significant downside risk to the labor market that overrides the fact that inflation is still on the way up. And he said that's even beyond tariffs, pointing to the service industry prices. And he also mentioned that they're getting closer to the end of QT, which makes the bond desks happy, but doesn't tell us much about the 29th of October. We were at, Jay Powell and myself were at the National Association for Business Economics annual meeting up in Philadelphia. And the economists had some interesting views there. They feel the Fed is only going to cut rates one more time this year because they're seeing some problems in the economy with inflation. It's still well above 3%. It's cutting into GDP growth, but that may change next year. There was an interesting couple of panels on employment, and, they're talking about an employment shortage because of the immigration crackdown that could be a major problem next year, and people, they think, are kind of overlooking that. So there's some gloom and pessimism out there among the economists, but nobody quite knows where we're going because, as Anne-Marie said, all of this stuff could just, with China and tariffs, bleed into 2026.
Mike, when you were over there, can you just sort of give us some detail, some colour on the kind of debate around the step down in payrolls growth we have seen and how many people think it's structural versus, say, cyclical?
Well, there's a little bit of a cyclical component here because, of course, the economy is slowing, but there seems to be a more structural issue longer term that the economists were concerned about. And they had a number of people who were demographic and hiring experts on panels who noted that because of the crackdown on lower income, lower wage, manual labor workers, the agricultural industries are already in trouble, and we're seeing signs of that. And especially construction is going to be in trouble going forward. One panelist said that there's going to be a 500,000 worker construction shortage in 2026. And the outlook very dour for the labor markets in terms of that and the retirement of the baby boomers. We're going to be short people, even though Jay Powell says it's not pushing up wages yet.
Mike McKee, let's hope it does. Because, anyway, all right, Mike, thank you. Appreciate it. We all want to get paid, don't we?
Right. You got to keep asking. We hope people are still asking.
Come on, they should be asking. Let's stick with the Federal Reserve. Tiffany Wilding of PIMCO writing the following. Chairman Powell's comments were consistent with our expectations that the Fed will cut rates again at the October FOMC meeting. Tiffany joins us now for more. Tiffany, good morning. So that's October. How much visibility do you have beyond October?
Yeah, well, I mean, I definitely think there's going to be more discussion around the December meeting. It does seem like October at this point is another cut. And I think part of it will be looking at the data that the government has not been able to issue since the government closure. And I think the concern actually is that the longer the government stays shut within October, there's not an obvious catalyst for it to reopen, like there has been in the past, to date, that you could have major issues around collections in October as the BLS field workers literally just can't collect the surveys. So you could have an October where it's not about a delay in the data, but a skip. And that's going to be, a difficult situation for the Fed come the December meeting. And I think it's going to make, their job even harder.
Tiffany, but how uncomfortable is it going to be for the Fed to cut with potentially not having the latest labor market report, but having a CPI report that estimates are showing a hot print?
Yeah, I mean, so I think that they'll obviously look at a wide range of data. We have gotten other private indicators of labor markets, the ADP data in particular, which has been very consistent, I think, with the signals that we've gotten from the BLS data, that labor market activity has slowed quite dramatically. And as Mike McKee discussed, there's definitely supply and demand factors that are slowing that. We've seen immigration policies that have reduced labor force, potentially even reduced labor force supply, certainly slowed the growth of it. But on top of that, though, you've also had these trade policies, tariff policies that are increasing costs across industries, making it a very challenging environment for some industries to work in, and that is resulting in a reduction in labor demand as well. So at the current point, we've seen a reduction in both. Of course, the Federal Reserve is worried about the downside risk to employment, and so I think that's the consideration going into October. Certainly we will continue to see some inflation reports that are above the central bank's target as you get additional price adjustments, but it does look like that's relatively contained. That is, and that will wear off eventually.
The impact of tariffs, will that become a bigger story in December, given a lot of companies, even during this earnings seasons, were talking about the fact that they were able to bear the brunt of it, but at some point they're going to have to pass on the cost to consumers?
Yeah, I mean, and I do think that as, the thing about uncertainty is, and we've had elevated policy uncertainty, is that you don't really want to make any adjustment to your business because you don't know, you don't know the sort of rules of the game, if you will. You don't know what the policies will be. But as companies become more certain that the tariff policies are here to stay, then that means they need to make the adjustments that that they maybe have been holding off on to kind of see how this shakes out. And I think companies have various ways that they can react to this, and within industries there'll be competitive forces that they'll have to deal with, and that's been one reason that we think that the price adjustment piece of this might not be where the full adjustment lies, and it does look like when we look across a range of data that the labor markets and companies trying to manage costs and labor costs in particular is also being part of the adjustment here as well. So if you have larger companies that can hold down prices, they can afford to do so, then that's a really tough operating environment for everyone else. They're going to have to cut costs. They're going to have to cut labor in order to to continue to manage in that environment.
Given some of the forces you described, Tiffany, do rate cuts help?
So, the Federal Reserve would still characterize their policy as being restrictive, in restrictive territory. And I think when you look at investment trends, excluding AI, they are quite stagnant, maybe even contractionary. That's both business investment ex AI as well as residential investment. Just looking at that alone would suggest to you that interest rates, are in restrictive territory. So I think the Federal Reserve would say, just given the balance of risks, moving back to a more normal stance, more neutral stance, at least, is a very reasonable policy. And that's what we think they're doing.
Of course, there's some debate about what neutral is, Tiffany, and it's a wide range of estimates. Where are you, and where do you think the Fed ultimately is?
Yeah, I mean, we think, we've sort of argued that on a real basis, kind of a 0 to 1%, these things are very uncertain, as you suggest, is 0 to 1%. So that kind of suggests, 2 to 3% real neutral interest rate. We think that could be higher within the band. There are various factors that have contributed to, a potentially higher, slightly higher neutral rate within that band over the last, number of years. But ultimately, that's going to be something that the Federal Reserve has to figure out. And, as they adjust policy slowly, they will get indications from the economy. And as they're cutting interest rates, if they see the economy is, reaccelerating and inflation is stickier than they expected, then, they can stop, they can continue, they can pause, see what happens, and they'll kind of get more, they'll sort of feel their way to neutral, if you will, and get more information. One other thing just to note as well is that fiscal policy in the U.S., we will get, more of the benefits from the offsetting tax cuts in the One Big Beautiful Bill Act in 2026. So that's something else that the Federal Reserve is going to have to navigate that could be tricky as well.
Tiffany, appreciate the time. As always, Tiffany Wilding of PIMCO, speaking to the go slow approach of this Federal Reserve and in many ways describing why this situation is so different to where we were in 24 when this Fed was a lot more aggressive. Equity futures on the S&P higher by 0.75%. Equities advancing this morning, going into the cash open later on this morning. Let's give you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Trump suggesting the $20 billion U.S. aid to Argentina could be contingent on Javier Milei winning the upcoming elections. Milei is less than 2 weeks out from a pivotal midterm election that is set to decide the future of his reform efforts. At least 30 news organizations rejected the Pentagon's new press policy. The policy prohibits journalists from accessing or soliciting information that the Defense Department doesn't make available for them. Outlets and networks including Fox News, CNN, ABC, CBS and NBC, none of them signed the new policy by Tuesday's deadline. Stellantis vowed to invest $13 billion in the U.S. over the next 4 years to help mitigate tariff costs. The plan will boost annual vehicle production by 50% over current levels. The dollar figure includes R&D, supplier expenses, and investments in manufacturing operations, making this the company's single largest investment ever. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, we'll set you up for the day ahead. Plus, we'll catch up with David Kelly of JP Morgan Asset Management to break down these markets and look ahead to the economic data we're not getting this week because the government shut down. So it's all about CPI. A week away, a week or two away, and then it's into the Federal Reserve at month end. From New York, this is Bloomberg.
We've got a 2-year target on the S&P of 8,600. And we don't think it's unrealistic to get there. You have a GDP that's reaccelerating next year. You've got multiple drivers of that. You have an AI industrial revolution going on that we think is very, very real. We're feeling that there probably should be some kind of a pullback. My guess is it'll be lighter than you think.
Steve Orth of Federated, bullish on this market going over the next 24 months, 2 years out. Equity futures right now, 0.75% higher on the S&P 500, on the Nasdaq up by 1%, on the Russell up by a little more than that. The opening bell about 42 minutes away as we count you down to that cash open. Here's the trading diary for the rest of the week at 9:15 Eastern Time. Talked a lot about this. The Treasury Secretary Scott Bessent and Trade Representative Jameson Greer holding a press conference on the economy. Look out for that. Look out for this too, 2 p.m. Eastern Time. The Fed releasing its beige book. Also today, some Fed speak for you from Myron, Waller and Schmidt, plus earnings after the bell from United Airlines. On Thursday, we would have been getting a lot of data, looking very unlikely due to the government shutdown. On Friday, President Trump meeting with Ukrainian leader Zelensky in Washington. That's the next big push on the foreign policy front.
Yeah, and the president talked about this when he was having this crowning moment and achievement in Egypt when it comes to what happened in Gaza. He said he wants to shore up what's going on in Ukraine. He said yesterday Zelensky's going to come in asking for tomahawks, as he expects. Pete Hegseth, the defense secretary, said there will be a weapons discussion, maybe not so much on Tomahawks, but this is all going to be about potentially more weapons for Ukraine.
Stay tuned going into the weekend. As we stick with the markets, let's stay with the US. David Kelly of JP Morgan writing many investors should likely consider diversifying their portfolios by adding alternative assets and international equities. David joins us now for more. David, welcome to the program, sir. Let's get to that statement. Give us the why. Why?
Because we've got a tortoise of an economy and a hare of a market. I mean, if you look at sentiment, it's practically submarine sentiment. People feel absolutely miserable about this economy, and I think that's overstated. But if you look at the economy itself, we're slowing down to a crawl in the fourth quarter. We're going to pick up a bit next year, but I think it's going to be less than 2% real GDP growth. But meanwhile, we've got this extraordinary stock market. We've got very high corporate margins, and on top of that, we've got price earnings ratios which are close to the dot-com bubble peaks. And when I look at that, it is out of whack. And so people should do everything they can to diversify their portfolios. They've drifted into being very overweight large cap US equities. And so I think they need to row against the tide and add other assets which are just not that expensive.
David, that's a struggle because the names we're talking about abandoning, Nvidia, Microsoft, Amazon, Meta, Alphabet, these have delivered fantastic gains. AMD, Broadcom, on any given day up 10, 15%. David, do you really want to give that up?
Well, there are two things. First of all, you got to be tax smart about this. So you should use new cash, stuff that you don't have to pay capital gains tax on, to try and rebalance the portfolio. But second, if you go back to the dot-com bubble, and there are growing echoes of that in what we're seeing here, every company was not a winner. There were some great companies which exist today and which are leaders today, which were leaders back then. But there are many other companies, more companies who disappeared then. So I think people just have to be very careful about valuations, company by company here. And it's I just think that everybody is essentially overweight the most expensive part of global capital markets right now.
So where do you suggest they should be looking?
Well, the first thing is U.S. investors are chronically underweight the rest of the world. And one of the things we've seen so far this year is the dollar's been coming down. And we know that the Fed is very likely to cut at the end of this month and probably cut again and just keep cutting, even though the economy is moving forward. Now, the European Central Bank is not going to be that dovish. I don't think the Bank of England is going to be that dovish. The Bank of Japan is going to be raising rates. So all of that tends to push the dollar down. So we think the dollar will fall. And what we've seen in the past, and we show this in our guide to the markets, if you have a long period of dollar weakness, you also get a long period of international equity outperformance. And so I think that's the first place I would go is, why do I only have 5% or 10% or 0% of my equity money in international? That's the first place I'd go. And then the second thing is just alternatives. Alternatives in general have not rallied as much as these sparkly champagne-filled public markets in the last 3 years. And that does leave some opportunities there.
David, though, when you think about international, do you have any pause or concern in terms of what we're seeing in terms of the rhetoric out of Washington and potentially companies and countries that can get caught up in this trade war between China and the United States?
Well, yeah, I think you've got to look company by company, but ultimately the rest of the world collectively is economically stronger than the United States is. So if you pick a fight with every kid in the playground, you may have a problem here. I think what's happening is a lot of countries are trying to find ways of operating outside of the U.S. sphere of influence. So I think what you'll see is over time, other countries, first of all, they're doing more fiscal spending in places like Europe. I think in China, they are very aggressively building up their technology base so they don't have to rely as much on U.S. technology. So I'd want to have a bet outside the U.S. I realize that what the U.S. is doing is not helping them, but it's not helping us either.
Well, David, let's talk about Europe. So European banks are up by 58% so far this year. And the ECB is projecting growth for 2026 of 1%. Now, if the US economy is a tortoise and the market is the hare, what on earth kind of an animal is Europe right now with the economy basically stagnant and the equity market ripping?
Well, Europe is a bit of a tortoise, but remember, you've got virtually no population growth in Europe. So on a per capita basis, it's not quite that bad. But these companies, the banking industry in Europe has been very cheap for a long time. So I think the rally that we're seeing in European financials makes sense. But I think you also just go company by company and also recognize that the euro is, I think, very undervalued. And if the euro goes up in value, and every time the euro goes up 5%, your European stocks are going to go up 5%. So it's a lot of the gains we've seen in European equities so far this year have been because of a rising euro. And we think that that trend has got a long way to play out.
The pushback I think we're getting around Europe at the moment, David, and I'd love your input on this, is when it comes to the major theme of the moment supporting both the economy and the market, which is AI, that Europe's in no man's land, that they barely have any competitors on the tech front, and when it comes to the energy needed to supply it, they're trapped by the left and the green lobby and can't do anything in response. David, what can they do to break out of that? And do you see any sign of that happening?
Well, yeah, they're not leading this charge right now. I think that's true. It still doesn't mean you should avoid individual European companies. And remember that, in the US, there's tremendous investment going on in AI. There's not quite as much cash flow coming in from genuine users at the end, and people are getting real value out of AI. So it's quite possible the capital spending cart will get ahead of the sort of income horse in AI in the US anyway. And also, we have to sort of look at this over time. Is AI really going to be a technology that you can sort of fence in the way that, for example, Apple was able to fence in hardware, and make money out of hardware forever, or Microsoft or Meta. So it's not clear in AI space who the ultimate winners are going to be. Is this a technology that really there will be one winner today? It's going to be the same winner 10 years out, or will it mutate over time? And will that give an opportunity to companies who aren't necessarily leading the charge here, but are able to catch up?
True. Thoughtful. As always, David, thank you, sir. David Kelly there of JP Morgan Asset Management, with equities near session highs up by 0.8% on the S&P. Coming up tomorrow, Brian Levitt of Invesco, Erica Najarian of UBS, Neil Dutta of Renmac, and a conversation you do not want to miss. Fed Governor Christopher Waller, live from New York City this morning. Good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.